introduce our host today, Jason Tibino, branch manager of J&J Financial here in North Philippines. Jason entered the mortgage industry in 2004, and in 2008, during the subprime crisis, he found a mentor who changed his life, not just by teaching him mortgage, but by showing him how to be a better human and a better man. The experience shaped how he leads today. In 2018, Jake launched his own branch with his business partner, now operate 2 locations across 4 states with a team of more than 30 loan officers. He leads operationally, not transactionally, with a focus on integrity, culture, and the human experience on and beyond the transaction. Please help me welcome with a big round of applause the host of today's 2026 Housing Forecast, Jason Tibino.
Thank you, Scar. I gotta hand it to you. This is the first day he met me and he said Thibodeau correctly. Wow, that's impressive. Guys, thanks for being here. Really, really do appreciate it. This is our 2nd annual. And we cut the RSVPs off at 200 because, we probably could have gone to 300 or 400. But I'd rather have enough room rather than not enough room. Hey, Mary, how's it going? So we're going to kick things off today with Logan. After that, as far as the agenda, it's staring at you in the face on your table. But for reference, Steven's going to finish after Logan. We are going to, because we all know attention span is a thing, we're going to give you an opportunity to take a break, go to the bathroom, grab lunch, get settled. We are this year going to have JMJ and our main sponsor. Where's my wife? Honey, can you come up here real quick, please? This is my beautiful wife, Lorraine Thibodeau. She's an escrow officer, but she also owns her escrow company. She's been doing escrow as long as I've been doing loans, since we were 20 years old trying to figure out how to pay rent and stay married. Hi, honey. Yeah, so she's our main sponsor today. She's going to get a chance with some of our team, our loan officers today, to talk about, in a non-cheesy, hopefully, way, why you should use us. Can I get the JMJ loan officers to please stand today? Just want to acknowledge you real quick. Hi, guys. Each one of them participated in making sure this event came together beautifully, and looks like it has. Nice work. And thank you, everybody, for your attendance. We do appreciate it. Hi, honey. Let's see here. So I was going to say, it's kind of funny. I had something planned to talk about real quick before we get to who you actually want to hear from. Interest rates. Last year, this time, January 2025, interest rates were at, any guesses? Love you, Mom. 7%. Okay. I looked up this morning on Freddie Mac's national average, 30-year fixed, it was 6.05%. And that is why we're all feeling a little bit busier right now. Now, of course, I also saw the other headlines today, and that wasn't very welcome. Apparently, there's something about Greenland. Do we really need Greenland? Anyway, Japan, I don't know if anybody follows market interest rates, but Japan's 10-year is now 2.35%, and that can be a little scary when you understand the carry trade, and it obviously impacts things here as well. So I'm not going to get into the granular detail on any of that. That's going to be for Logan and for Steven, but it's important to be reminded we have come a long way. 7 to 6, we'll take it. Let's see here. I'm almost done. I will get in trouble if I don't hit all my bullet points. Agenda, we've talked about that. Oh, headshot reminder, guys. Okay, if your headshot is older than 10 years, you know who you are. Right around this corner, this lovely lady named Jess will get you updated headshots. Yes, we are not doing it for free. RESPA would not like that. It's $125. Now, J&J has a studio called Studio 919, and if you've seen me on Instagram, that's the studio. You get 30 minutes. I might even give you a little bit more time if I'm feeling generous, if you end up taking a headshot. You will leave today with 2 fully edited headshots. Correct me if I'm wrong. And there's the nudge. Right, now I'm not going to get in trouble, but I do think you should. Thank you to the venue, the vendors, Scott, Jess, Corey. Where are you, Corey? Hi, thank you. Making my life easier. All right, I'm going to shut up now, guys. Thank you. We are really, really grateful for your presence here today. And what's so cool is we actually have some incredible speakers. I don't know, by show of hands, who was here last year? Okay, cool. Right on. So you guys are in for a treat. So you know, and maybe the others have already heard, but I'm really excited to see the latest and the greatest. Logan Mohtashami, he's referred to as the chart daddy, right? He's the guy that actually has models, that actually has real data to formulate his projections and his opinions. So you want to be listening to him rather than the guys on X or Twitter doing the real estate's gonna crash routine. All right, without further ado, Logan Mohtashami with Housing Wire. Thank you, Logan.
It is wonderful to be here. As a resident of Irvine, California since 1988, I love speaking in Orange County. This is my 12th event this year. And, you know, I've been in Utah, it was 26 degrees, Boise was 17 degrees. So it's wonderful to be here in sunny California. So today, my job is to basically tell you what is really going on in the housing market. Let me get this there. But also to explain what the economics is. This is the first time, I would say, in 4 years that everything that I'm going to tell you is actually positive. But it's why, right? Real estate is local. You know, what happens here is different than what happens in Florida. What happens in Florida is different than New Jersey. But the economics of housing, what moves the housing market up and down in demand, right? All of you here are here because you want to do more business, right? You want to sell more homes. You want to have your buyers backdrop we've had in many years. But the charts in here will explain why, so you could explain to your clients what is really going on. We've called this the Nerd Tour. We've done it for 3 years. And just remember, these charts at the end of the presentation, I will be able to slide in your DMs by using a QR code, and you could have access to everything. And the compliments that we get is that realtors, loan officers, Wall Street, yes, even the Federal Reserve follows my work. They say, I understand it better. And you could explain it better right now. So today's theme is what's really happening with the housing market. And my first question I always ask everyone, how many people here have been married for 20 years plus? How many people here love to slow dance? Okay, we have a few. There is a couple that have been slow dancing since 1971. It's the 10-year yield and 30-year mortgage. Sometimes they slow dance close, which is what we like. We like 1970s Soul Train slow dancing. Sometimes they slow dance far apart. We don't like that. That's 2023. How many people here are familiar with the term mortgage spreads? Okay, yes. Mortgage spreads is a very positive story, especially what happened today. But as you can see, you know, they flow with each other. Now, last year was very confusing to a lot of people because last year everyone said rates are going to go up higher and stay higher. There's no way mortgage rates will fall down in 2025. They gave a lot of good reasons. They're all wrong, but they gave a lot of good reasons. Number one, inflation. It's true. The growth rate of inflation rose the entire year. Number two, you know, we have $36 trillion in debt. We are a broke country. Nobody's going to buy our bonds. That's a boogeyman. That's never existed. And then also last year, we had $10 trillion of bond supply that are going to come to the market. And there's no way the U.S. could take on that supply. Well, none of that worked, right? Mortgage rates fell for the right reason. The labor market got softer. So in 2022, I came up with the theory that the Federal Reserve is not going to get really dovish until the labor market gets softer. So hashtag labor over inflation. Sarah Wheeler, my podcast partner, and I, we have a top 10 business news podcast. We go around everywhere. We say paper, rock, scissors. The labor market will push rates lower in 2025. 2025 was the lowest job growth in the 21st century. We averaged 49,000 jobs per month. If it wasn't for healthcare and social services. So with that in mind, where are we right now? Now, oddly enough, today, because of I am not in Davos. AI creates some really great photos, but it looked like I was speaking in Davos last night. I wasn't. The 10-year yield has risen up a few basis points, but if you can see this, From the start of the year last year exactly, mortgage rates were 7.08%. Today, 6.21. Now, why is that a difference? Over the last 3 years, every single time when mortgage rates head toward 6%, we get a couple 100,000 more home sales. Since the end of 2022, mid part of 2024, and right now. How many people are familiar with Redfin? Okay, you got to be really, really careful with their economic data. Last year, they came up with this really crazy stat, and they said that, there were more sellers versus buyers in the history of America, right? Every doomer took that and said home prices are going to crash. They said it was the highest cancellation rates ever in history. There's no way sales could grow. Delistings were at the highest levels ever. There's no way. During that entire time, existing home sales rose 420,000, right? We are basically in multi-year highs in pending home sales, purchase application data, and existing home sales because of this. The 10-year yield slowly moved lower. But the big thing and the big difference now than the last few years is what we call mortgage spreads. And what the hell are mortgage spreads? Well, mortgage spreads, when we talk about the slow dance, we want intimate slow dance very close. It's the difference between the 10-year yield and 30-year mortgage. Now, in 2023, that difference was 3.11%, which means mortgage rates today, if we took the worst levels, are 1.25% higher right now. We're well over 7% today if we had the 2023 spreads. But the history of mortgage spreads, they get better over time. When the Fed starts cutting rates, volatility compresses, mortgage rates tend to act better, and today we're not that far from normal. Normal is about 160, 180. This is the unsung hero that nobody knew about last year because we wouldn't have had 6% mortgage rates at all if this didn't occur. And then a few days ago, the president announced they're going to buy $200 billion more mortgage-backed securities. All that does is it tries to keep a lid on mortgage rates on a day like this today. This morning, the 10-year yield was up again. Mortgage pricing was up 14 basis points. But today, mortgage rates are 6.21%. If I go 3 months ago, today we're talking about 6.35 to 6.40. If I take a year ago, we're talking about 6.62% mortgage rates. The spreads are your friend. Take butter, peanut butter jelly, whatever, take a piece of bread, put it on there. This is going to stay here the entire year. This means mortgage rates can stay lower for longer. And another thing is, it's the midterms. They're going to announce a lot of things tomorrow that are going to be pro-housing. Maybe we get the capital gains from $500,000 to $1 million or some kind of version of that. Supply, maybe something to help builders build homes, less regulations. But whatever it is, it's the midterms. And they are not going to mess this up because the last thing they want to see is mortgage rates go back up because that's what's happened the last few years. Whenever we get rates down to 6%, things will go well, shoots right back up to 7%. But because of this, it got better in 2024, it got better in 2025, we're almost back to low. All of you can work in kind of a lower, less volatile mortgage rate market. And this makes a difference because every single time we've done this, a couple 100,000 more home sales. Just imagine an entire year with mortgage rates near 6% or even lower. That's the backdrop that we have this year that hasn't been the case over the last few years. So this is all a positive, and this is something I never could talk about over the last few years. Now, the unemployment rate. If I believe the labor market is more important than inflation, so what's going on with the jobs market? I mean, we literally had the lowest job growth in the 21st century. People say, well, population growth is slowing down. Manufacturing jobs have been losing jobs since the start of 2023. Mortgage rates were elevated. Housing permits are at recession levels. Housing starts are at recession levels, right? Policy is too restrictive in the sectors that are losing jobs. So the Federal Reserve begrudgingly decided to say, okay, the labor market isn't as strong. Positive for all of you here, because if they keep on talking about that, we can keep rates lower for longer. But unemployment rate at 4.4% still very good historically, but it's rising from the lows. And there's no longer that the labor force growth is too strong and that's pushing the unemployment rate. This is authentic softness in the data. And when there's more drama around the world, it's harder for businesses to make decisions. We saw this during the first trade war tap dance in 2018 and 19. We're seeing this again. So part of the reasons why there's less job growth right now, even though there's more unemployed workers than job openings, is a little bit of confusion for business decisions. So, but for you, softer labor market, all of you do more business in that environment. Now, why are the builders struggling to build homes? Does anybody want to guess how many completed units for sale the builders have across the country? Anybody want to guess the number? 122,000 completed units for sale. Now, we have over 147 million total units altogether. 120,000 doesn't sound a lot, right? Except the builders never let it get too much above there for decades. Why? I always say the builders are very simple. They are not the March of Dimes. They're here to make money. If they start building a lot of homes, then prices would go down for them. Their profit margins fall. So it's not shocking that housing starts and permits are at recession levels in a time where everybody said, oh, we need to build a lot of homes. And I always tell people, so cute little kids. Builders don't operate this way, right? As soon as they get to this level, they were already pulling back right now. So this is something that the White House might talk about, but it's going to be very difficult unless rates get down, right? Rates going lower, more new home sales, completed units fall, permits rise. But the mother of all jobs data is jobless claims. This is the one thing the Federal Reserve is holding their hat on. Every economic cycle post-World War II, this data line breaks out, right? These are more people filing for unemployment benefits. I know a lot of people say, well, nobody's filling them out. Trust me, when there is a job loss recession, you can't hide this. This will start break out. Oddly enough, if this gets worse, all of you do more business. Why? Rates go lower for longer. Now, it's going to be a very tricky year this year because guess what? We're going to have a new Fed chairman in a few, start at the end of May. That person is not going to be like Jerome Powell. Whether they can get a lot of rate cuts in or not, I doubt that's going to be the case, but whatever it is, there's going to be a more dovish theme going into 2026. So for all of you this year, unlike the past few years, what do we have? Better spreads, and eventually you're going to get a more dovish Fed chairman. So this is good for housing. But when this data line breaks, all of you do more business because rates could go even lower for longer. Existing home sales. I love this data line. I take it all the way back to 1968. If I told you home prices rose faster from 1977 to 1979 with mortgage rates going from 8 to 13% than 2020 to 2022 when mortgage rates were sub 4%, would you believe me? Because that's what happened back then. Home prices actually rose faster from 74 to 79 than what we did during COVID. Except back then, mortgage rates went to 18%. So housing affordability was much worse, actually, in the late 70s, early 70s, than what we have right now. But I like to compare this market to the 80s versus what happened in 2008. In the 1980s, back when the baby boomers were the millennials, they were buying lots of homes, labor force grew, home sales exploded, prices exploded, then rates went up to 18%, home sales crashed. But not a lot of people know this. Did home prices fall at all in the early 1980s? We had 2 recessions, we had a lot more inventory, credit data was worse, but did home prices fall 1 year? No, they didn't. Rates fell during the first recession. Look what happened. Even with affordability worse, sales took up. The second recession, home sales fell, bottomed out, and then not only shot up, but they rose for years. If you look at these gray bars, these are recessions. What do they look like? That's when home sales typically bottom out. And then rates go lower, right? Every year wages grow, households form, home buyers have better buying power. It increases every single time. Look what's happened here. We've had, if I take new home sales and existing home sales together, we have near 5 million total home sales every year, 2023, 2024, and 2025. But now, affordability is a little bit better, right? Home price growth hasn't been that big the last 2 years. Wages have exceeded home prices, and rates are staying lower for longer. If I take history, we should stay near the sixes. It'll be the first year of growth in home sales. And always just remember, whether we go into recession or not, I kind of have this theme. How many people remember what they were doing on April 7th, 2020? Who's holding toilet paper here? Anybody want to raise a hand? Okay. On April 7th, 2020, I wrote a COVID-19 recovery. I just started working for Housing Wire, and I said, hey, listen, we're going to recover as an economy this year, but the existing home sales market will come back within 6 to 8 weeks. They're like, you are crazy. I was like, no, I'm not. They are. I'm going to go get little baby carrots for my tortoise, and I just see people hoarding toilet paper and wine. They're crazy. But the recession was very big back then. We had 25 to 30 million people unemployed. We had 5 million in forbearance. So my smart economic friends, they always tell me, Logan, who is going to buy these homes? You keep on talking about this big rebound. There's 30 million unemployed. I said, oh, you're cute. There's 5 million in forbearance, 35 million people off the grid. But I tell them this, my army's bigger than yours. They're like, what do you mean? I have 133 million people still working with 3% mortgage rates. As soon as they stop hoarding toilet paper, sales will rebound. Sharpest and fastest home sale recovery in the history of planet Earth in 2020. You can see that straight vertical move. Why? Millions and millions of people buy homes, right? Supply is a function of demand. 70 to 80% of home sellers are buyers. That's how you get near 5 million total home sales the last few years. Now, the peak in the last decade was near 6 million. So if you run into people that say, oh, we are going to go into a recession, nobody's going to buy a home, just tell them, my army's bigger than yours. I got 162 million people still working. I have 5 generations of home buyers, silent generation, Gen Z, millennials, baby boomers, and the greatest generation of all time, Gen X. How many Gen X people here? I still have my AOL account. So when you look at this data, what do we know? Rates getting near 6%, demand picks up. Last few years, rates have shot up above 7%, demand falls. The flow of data. But just imagine this year, better mortgage spreads, better affordability, more people working, record low levels of sales, but rates going lower, and the midterms. It's a better backdrop this year than we've had in the last few years. But this gives you context for the existing home sales market. Now, another great thing is purchase application data. Mortgage purchase application data is a trend survey from the Mortgage Banking Association. They have their mortgage brokers or bankers, whatever, fill out an application. We're at multi-year highs starting from last week, right? Even last year was very confusing in its data line. We had year-over-year growth every single week where we're working from record low levels. Like last year, the bottom was the 1995. 1995, no doubt, was the top new band. Gangster Paradise was the #1 song. I had blonde hair back then, auditioning for Levi's commercials. That was a long time ago. So the year-over-year growth, you have to take it in context last year. But what happened last year is we had a lot of sellers ready to sell and buy another house. They quite just didn't get that mortgage demand to go there. Just remember, seller is a buyer. When soon as they buy that house from a mortgage buyer, they go buy another one, transaction volume picks up. So this year is very encouraging to see the start of the year with mortgage rates near 6%, multi-year highs in purchase application demand coming from the last existing home sales print being at 4.35 million. So the start of the year is good as long as rates 6.25 and under, we got this to handle. Now, here at Housing Wire, we have a way of tracking data a little bit differently. We track things live weekly. It's a little bit of an unfair advantage, we say. We get contracts, they're about 30 to 60 days ahead of what happens in the existing home sales report. We're about 3 to 6 months ahead of the Case-Shiller Home Price Index. And we saw this toward the end of 2024 to 2025, that no matter what the headline was, housing demand was picking up versus the previous years. The one variable constant, near 6% mortgage rates. And we saw it again last year as well. And now we're working from a little bit higher bar out there, but the demand is there. And just think about it. When you stay at very, very low sale levels, those people didn't leave. We have so much, I traditionally do not believe in the pent-up demand theory, but sales are so low for such a long time that you get any kind of kick of rates getting near 6%, our data always shows growth. So this is the positive about this year, because at the end of 2024, mortgage rates are already above 7%. Last year at this time, already above 7%. Not the case. We've been near 6% for some time now. We're doing a lot of mortgage-backed security purchases. It's midterms. We're going to get a lot of things positive. The backdrop is better for everyone in here. One of my favorite charts. I call this crayon economics. There's a lot of crazy people on the internet. YouTube, TikTok, Instagram, Facebook, all these housing experts. None of them could read. So I thought to myself, I'm going to dumb this down by taking a crayon and just drawing lines out here. This is the NAR's total active inventory going back to the early 1980s. Normal is 2 to 2.5 million. You guys want to guess where it was in 2007? 4 million. Do you know what it is in the last existing home sales report, December? 1.18 million. These people are so crazy that they've evolved from it's housing 2008 to worse than housing 2008. So I figured, okay, none of them can read, but we're just going to draw these lines. Now, the interesting aspect about this is that in the previous decade, inventory used to rise with sales. Inventory rise, sales rise, prices rise. Right? We saw that in previous decade. What happened that is so different in the last 12, 13 years than the previous? Qualified mortgage came in 2010, which means every home buyer is pretty much legit. If 70 to 80% of home sellers are buyers, that's 20 to 30% of inventory that's left over. What creature in the last decade was buying millions and millions of homes and not giving you one beforehand? It wasn't BlackRock. It was those pesky millennials. They were the criminals. I always think of Scooby-Doo and opening that's them. They don't even give you a house. They can't buy avocado toast, but they were the biggest home buyers in America. So they were driving the inventory slowly lower. Why? They were the biggest housing demographic patch in the history of America. And they're normal people. They're just like the baby boomers were back in the late 70s. I do the same skit. I'm sure some of you have heard it. We're not complicated people. We rent, we date, we mate, we get married. 3.5 years after marriage, we have kids, we buy single-family homes. That's what we've been doing post-World War II, except we had a lot of millennials. And then going down to years 2020 to 2024, guess what happened? It was the biggest millennial demographic patch in the history of America. Ages 28 to 35 were the most massive in history. So inventory broke to very, very low levels. Not a very good thing, right? But what's happened, we've increased a few things, right? Inventory has grown the last few years. Much healthier housing market. But if anybody tells you it's housing 2008, okay. Don't ask them to read. Just show them this chart. You can get the QR code and get this and just say, hey, crayon economics. That was 2007. No, it's not 2008 or worse than 2008. But this gives you and your clients visuals on what's going on. Now here at Housing Wire, we track inventory a little bit different than the NAR. We track raw single-family homes available for sale. We could do it for condos. We could do it for every city, state, and zip code in America. Wall Street comes to us. The Federal Reserve comes to us. Real estate investors come to us. Prolific realtors come to us because we give fresh data that looks out, 3 to 6 months. Inventory last year, growth was really good. I was very happy, except in mid-June, for those of you that's followed my work, have been pounding this, the housing market was shifting. right? The growth rate of inventory was slowing, new listings data was slowing, but mortgage rates were just about to break under 6.64. And every single time when that occurs, housing demand picks up, supply and demand economics, inventory growth went from 33% at the high point last year down to 10%. That's how supply and demand equilibrium works. We break it down to a level that I believe is a little bit more sophisticated than others, but it's a healthier housing market. But just to show you how bad things were in 2022, did anybody want to guess how many homes were available for sale in March of 2022 nationally? Single family homes just available for sale, no contracts on them or anything. We only had 240,000 homes available for sale in the entire country in March of 2022. You guys remember the game Hungry Hungry Hippos? Right? Too many hippos! Just a few balls. I remember it was so bad back then. I saw this really old house in Los Angeles. It had 287 people waiting in line. And it was such an unhealthy housing market because when you have too many people chasing too few homes, prices get escalated out of control in a very unhealthy fashion. So what has occurred is inventory has been growing and growing and growing. We're not back to normal, but we're in a healthier housing market because price growth cools down, wages rise, affordability gets better by itself in that, and then rates go lower. Voila, 1980s all over again. So inventory growth, it's up just 10% year over year. It's not the same growth we had last year, but in a healthier spot for all of you, what I call the chart daddy doctrine. It's a tug of war this year. It's the first time we've had a tug of war between sellers and buyers, right? Buyers can finally get into the mix and go, okay, right? We could be a part of this. Sellers have to be a little bit more realistic that it's not the markets of the past. That is a healthier market for all of you to do more business in the future. Now we have a data called new listings. We cherish this data. Not a lot of people had this in the past. Mike Simonson, who is my colleague, who now is the economist for Compass, Housing Wire owns Altos. It's our data line now. But when he first started the company, he went to a Wall Street event. He saw Lehman Brothers. He went up to Lehman Brothers. He said, guys, we have a way of tracking housing that, we think is, pretty good, and we think the housing market is breaking. Lehman Brothers went to him and said, I don't know who you are. I have 85 analysts. Go away. Mike sees Goldman Sachs, walks toward Goldman Sachs at the same event, shows Goldman Sachs the data. You know what Goldman Sachs did? They were like, oh boy. They not only took the data, they shorted the housing market, made $10 billion. Lehman Brothers went out of business next year. We believe we are the most prolific housing data trackers on planet Earth. We are not shy about it. We'll debate about it. Our weekend tracker that I write every time incorporates everything. The slow dance, the spreads, the 10-year yield, active inventory, new listings, price cut percentages. But the new listings data, these are the homes that come onto the market that don't have a contract. Normal new listings during the seasonal peak nationally is 80 to 100,000. That's like normal. That's 2013 and 2019. We haven't had a normal year yet. So for all the Airbnb crash, oh, by the way, the one group of people you never listen to are middle-aged men podcast stock traders. Never ever get housing advice from them, right? Because they're on Prozac, they're on margin. They think home sellers are just going to sell their house and do what? I tell them, I said, why don't you go tell your wife you're just going to rush and sell the house? Ask your kids what school they're going to go to. Homeowners don't think like stock traders, so the new listings data, not surprising to us, never broke away. Between 30 to 90,000. Do you want to know what this was doing during the housing bubble crash years? This was running at 250 to 400,000 per week for years. And we've been at 30 to 90,000. Why? Back then, a lot of forced credit sellers that weren't going to be buyers. So we always tell everyone, if housing was ever breaking, we'd be the first person to know it. I would be the first person to know this because I have nothing else to do. I just look at charts all day. Literally, at Friday night, I write the article, and I go, oh, it is not happening. But if it did, this data line would be it. So if your clients run into those people in YouTube who say home prices are going to crash 50, 70, 80%, just remember, none of those people are data analysts. They're entertainers. Because if they were analysts, they'd go, oh, no, housing isn't breaking. So again, a good start to this year. Most home sellers or buyers, we want this to get back to 80 to 100,000 in the seasonal peak months. That means more of you will do business because once that seller puts the house on the market, majority of the times he's going to buy a house. Very positive last year, but we didn't quite get back to normal. This year, it does look like it did. Another positive outlook for 2026 that I couldn't say in the last few years. Now, how many people here knew that 1/3 of all homes get price cuts year-round? A raise of hands of people that knew that stat. Well, you guys deal with sellers. Sellers think their homes are worth more than they are, so naturally, 1/3 of them have to cut prices. Look what it was during COVID, 2022. Nothing happens good in housing when anything's at a teenager percentage. I mean, days on market or price cut percentages, either demand is booming beyond belief or you have way too many or not enough homes for the market. Price cut percentages are back to a healthier number. That price growth has slowed down. We went from 10% price growth in 2020 to 19% in 2021. 2022 was 6%, 2023 was 6% growth nationally, 4%, 1% to 2%. All this creates a better backdrop for all of you to do business going out in the future. Price growth cools down, wages rise, households form, rates go lower, demand picks up. Boring housing economics. But that's what's been happening in the last few years. So this backdrop is another positive. But if we saw something that was breaking, 2022, right, when rates went from 3 to 7%. The slope of our curve, of our data line tells us, after that, pretty normal. So healthier housing market on the price growth front, healthier housing markets on the spreads, healthier housing markets on rates, wages, inventory, midterms. The White House is going to announce a lot of things probably tomorrow, all positive. Okay, how many people here were told BlackRock bought all the homes? Raise a hand. Okay. The company's called Blackstone. Like, I could get it. Black, rock, stone, the rock versus the stone, WWF wrestling. Okay, maybe. Blackstone bought 0 homes. BlackRock bought 0. Blackstone owns 0.06% of all the homes in America. This is a boogeyman. It's always been a boogeyman, but a lot of home sellers or home buyers think, oh, well, Wall Street owns all the homes. As soon as they sell everything, prices are going to crash and they're just going to buy the homes all back. No, it doesn't work that way. Mom and pop investors have been the majority of home investor buyers for decades. You don't hear anything about them, which is the funny part is Scott Bessent today, this morning on Davos said, we don't want to go after your mom and dad. They have 5, 7, 10, 12 homes. We want to go after institutional. I was like, mom and dad have 10, 12 homes? Okay. So I'd love to visit any of them. In any case, the reason why they don't go after mom and pop investors is they can easily say, hey, listen, I get this question for 10 years. Why don't you just give these guys capital gains tax-free? Let them sell all these homes, have all this inventory. And I go, what are the people going to do in those homes? They're not empty. You have to kick out millions and millions and millions of families on the streets, and you're going to have a politician sign off on that. And guess what happens? Less rental supply, more demand for rents, because everyone's got to go find a house really quick. That's inflationary. 40% of CPI inflation is shelter, 25% of that is rent. Inflation goes up, families are kicked out. What politician is going to sign off on that? So if you ever wonder why they go after the smallest percentage buyer, doesn't matter to them. They're way too small. The mom and pop investors run the show, and they're never really going to go after it. So if you run into clients that are flayed about the BlackRock things, tell them it's Blackstone, they own a very little, this is not a big story. Now, one of the things that my counterparts across the world, they hate us so much. Canada right now, you know what Canada is doing 90-year loan modifications? Yeah. Your mortgage is going to outlive your great-grandkids. And why is that? Well, they don't have the 30-year fixed mortgage. What's the best hedge against inflation on planet Earth? Don't say Bitcoin. It was real estate not for the price reason, but it was for the 30-year fixed mortgage. Fixed debt cost, rising wages, your debt cost stays the same. So what does that mean? After qualified mortgage came out, we created the best financial middle class homeowners in the history of planet Earth. People go, America's broke. They have $37 trillion in debt. I go, Homu, we have $200 trillion of financial assets out there. If I took the U.S. land and military and everything, it's like a $400 or $500 trillion country. Maybe Cleopatra, in her prime, adjusting to inflation, had more wealth than American homeowners, but nah. This is as beautiful as you get on the data line pool. Majority of households have 740 and up FICO scores. Why? Because they have 30-year fixed. They don't know 228s, 327 option arm, recast, anything. They stayed in their house. Their wages rose every year. Their cash flow looks excellent. There are a lot of fake housing grifters out there that say Americans are poor. They're going to all sell their homes. And no, it was never in the data, right? Those are entertainers, but now you have the data right now. So if you need to show anyone, hey, listen, homeowners are doing great. It's not housing 2008. The FICO score was much different. So this is a benefit because all of you in this room created the best financial middle class in the history of planet Earth. FICO scores are so excellent. I got to tell you, this thing is so beautiful that around 8 o'clock at night, I get some cognac out, I put some jazz music, and I just sit and look at her and say, God, so pretty, right? All of you did this because you put your clients into 30-year fixed mortgages. Now, my nickname really is the chart daddy. So Sarah Wheeler, my podcast partner, Housing Wire Daily, we're on 4 times a week. I told her, when I die, you put this chart on my tombstone, you put chart daddy as my name. I've been fighting a guy named Uncle Dave for 15 years. I'm convinced everybody in America has an Uncle Dave. Uncle Dave's the guy that comes at Thanksgiving and Christmas and says, home prices are going to crash. You kids are idiots if you buy homes. I'm going to wait until prices crash 40, 50%, and I'll buy all the homes up in foreclosure. And you know what I tell Uncle Dave? Oh, here's crayon economics again, because clearly people never read the foreclosure data. We draw these little lines. I go, homie, it is not 2005. It is not 2006. It is not 2007. It is not 2008. God, it's not even 2019. This is the foreclosure and bankruptcy data that the New York Fed brings out every quarter because they take the FICO score data or the credit data and they go, okay, people are stressed out. This little, if you guys can't see, I don't blame you, that's their foreclosure crisis. Again, they are entertainers. None of these people are housing analysts, right? Look at the bankruptcies back in the early part of the century. What was going on then? Well, 2005 bankruptcy reform law. Once that law was going into effect, everybody filed for bankruptcy to get ahead of it because you can't just pile up credit card debt and file for bankruptcy anymore. 2005 bankruptcy reform laws, 2010 qualified mortgage laws changed the United States economy for this rest of the century because credit data looks so much better. So if you're running into clients that say, but I'm worried about housing 2008. Well, there was housing 2008. That's 2026. Visually show them the data, changes their mind. A lot of people start to feel better. Then you become the expert because by now you know more than 99.9% of the people on planet Earth. Now, where do we see stress in the credit data? Renters, low-income households, renter households, elderly Americans that have renter income profiles, that's where we do see the stress, but not in homeowners. A lot of people go, Logan, how do we have near 5 million total home sales in America with affordability and prices and taxes and insurance? I go, well, if you take the NAR's data, you need $103,000 to $105,000 to buy a house. Dual household incomes. One person makes 70, the other person makes 90. That's how you get near 5 million total home sales. But now, affordability got a little bit better by its own. Wages up, price growth cooled down. Now rates are lower. Mortgage spreads are better. Inventory is up. This backdrop is the healthiest backdrop we've had in years, so it isn't shocking that home sales went up a couple 100,000 in the last few months of the year because rates got back down towards 6%. Equity. Does anybody want to guess the percentage of homes in America that don't have a mortgage? 40% of homes in America do not have a mortgage. Hard to have a foreclosure crisis, right? In any case, the ones that do have a mortgage have a lot of equity. Now, this is one stat that hardly anyone talks about, but I'm like literally one of the biggest nerds in the world. In 2001, the down payment percentage in America was falling. It was getting smaller and smaller and smaller. In 2008, it was the lowest percentage in the 21st century. The last 3 years have been the highest. We were averaging about 15 to 18% down payments. All classes, right? Move-up buyers, move-down buyers, even first-time home buyers, their down payments were the highest. So naturally, you're starting off at a good rate, and then everyone been sitting in their homes for a very long time. Prices appreciated a lot. Average housing tenure from 1985 to 2007 was 5 to 7 years. From 2008 all the way down to 2025, it's been 11 to 13 years. Some states, 15 to 18 years. I've lived in my home in Irvine for 21 years. People are living in their homes longer and longer. Their wages rise. Their incomes to debt looks really good. And they have so much equity. So the killer data line is, if I took all the homes in America, with mortgages and without, what do you guys think the percentage of the loan to value is in America today? Taking every single house in America. Anybody want to take a guess? 44.3% loan to value for the entire country. And they're telling me a foreclosure crisis? Do you know how many recessions we've had post-World War II? A lot. How many foreclosure crises have we had? One. That Uncle Dave chart, right? Credit was breaking 4 years before the recession. Loan to value back then, 85% in 2008. Loan to value now, 44.3. And they're saying it's a foreclosure crisis. Wait till you buy homes 20, 30, 40% off. If I took 2007 and 11 out of the equation, post-World War II, how many years have home prices fallen nationally 1%? Anybody want to guess? 0. In 1990, home prices fell nationally 0.7. Southern California was the reason for that. 1991, 0.2%. Homes do not act like stocks for a reason, right? One of the biggest reasons why we had 2008 is we had a higher percentage of sales that were distressed. Anybody want to guess what the percentage of underwater homes were in America back in 2010? Over 23% of homes were underwater. Today, that data line is so small I can't even see it. It's less than 0.5%. So going into 2026, what do we know? Lower rates, better mortgage spreads, more inventory, price growth is cooling down, government wants housing to do better. We're going to get a lot of housing initiatives because of the midterms. All of you here have the best backdrop for sales for multiple reasons, but now you could see it. Now you could see this data. There's a lot of selling equity out there. Now, how many people here believe in the concept of the mortgage rate lockdown? Okay. The mortgage rate lockdown was a theory that nobody in America would ever sell their low mortgage rate, and that they were in the golden handcuffs, they said. Because we had a lot of people, or we had basically 12, 13 years between rates between 2.5% and 5%. And what crazy person would sell their low mortgage rate to buy another house? Well, we have more people with 6% plus mortgage rates than 3% and under now. Because every single quarter since 2022, some crazy person sold their low mortgage rate house and bought another one with 6, 7, 8% mortgage rate. Life finds a way. People have to move. If you can afford it now, especially with all that equity out there, total payments, that's what matters. So we've had, at the highest percentage point in 2022, 40% of all the homes in America had 3 to 4% mortgages. That's gone from 40 down to 30, right? The 6% plus mortgages are about 5.99% back then. Now it's about 22%. So don't think that you are dealing with a locked-in home seller that doesn't want to buy a house, because every single quarter, we used to see it in the coupon data, people were selling their house to buy. A mortgage rate lockdown is like a doomsday theory, right? If you didn't have baby boomers or Gen X or anybody selling their house to buy a house, elder millennials, home sales would be so much lower. But every single quarter that's happened. But now, lower rates, less volatility, a little bit better affordability, more inventory, healthier housing market for 2026. That's what we're all dealing with in this room. And we have tons of data to show this now. So home sales picking up the last few months should not have been a surprise. Now, we're getting into the really nerdy charts. Homeowner vacancy rates. This is another way to explain to people. People just don't sell their house to be homeless, especially when you have kids. If your kids eat off the streets, the cops are going to come and take them away. Even during the biggest housing crash in the history of America, homeowner vacancy rates never hit 3%. Why? You have a product, it's shelter. People have to live somewhere. They have to raise their families, they got to go to work. So the homeowner vacancy rate today is 1.1%. So when they tell you millions of homes are going to come to the market, it's not in the data. If it wasn't in data, you follow us, we'll tell you new listings data is taking off. Not the case right now. What has increased, which is beneficial for everyone here, is rental vacancies have increased. Now, why is this beneficial for all of you? 40% of CPI inflation, shelter, rents. They built a lot of apartments. Rentals, supply goes up. The growth rate of inflation in terms of service, it's very hard to have breakaway inflation unless shelter takes off. Wage growth is slowing down. The Federal Reserve actually believes in this thing. If they get wage growth down to 3%, 1% productivity, you get 2% inflation. So oddly enough, this rental vacancy is a benefit for all of you because it's really hard to have breakaway inflation. In fact, if I go all the way back to 1910, the average CPI inflation rate is 3.3%. The last 18 months has been under that. If I take World War I, World War II, the late 1970s, out of the equation, you don't have breakaway inflation one time. Global pandemic, very inflationary. World War I, we had a global pandemic back then too. Pandemic's very inflationary, then the disinflation happens. But with this data line, begrudgingly, and I bash the Fed all the time in my podcast because I know they're listening, it is very, very hard to have breakaway inflation with this. We had tariffs, we're collecting revenues, goods, there's all these things out there. This, with energy prices low and wage growth cooling down, Federal Reserve can be a little bit more dovish than they are right now because history has shown us you can't have breakaway inflation right here. Now, if you really, really want to be a nerd, if you want to access to this presentation and the weekend tracker, and mind that the Federal Reserve, I know they follow us because I can see their email addresses when they purchase our stuff. This QR code gives you all of this. If you're in there, our Housing Wire website, we're going to have the ability for everyone to get those data lines for every city and state and zip codes, new listings, active listings. Those things are what we're kind of known for. But my job for 2026, for 2027, and every year is to teach you all the economics so you could talk to your clients, your friends, and your Uncle Dave and be more confident in explaining. Because in this day and age, the best antidote for fear is data. And everyone's got it now, so you don't want to be behind the curve in terms of talking to your clients, because if they say, hey, listen, what is really going on? Trust me, the realtors that we work with, bang, bang, bang. They have all these reports out there, new listings, active listings, everything. They sound like me. And all of you will have access, and all of you know how to talk about it, crayon economics and everything out here. 2026 is the best backdrop for home sales to grow in the last few years. Thank you all for having me.
Logan, thank you so much. Okay, everybody, we are going to do a quick transition over to our favorite local housing economist. I might talk for a couple minutes to give some people a minute to go to the bathroom. Reminder, we are recording this, so at the end of the event, of course, it won't be immediately available, but it will at some point in the next week or so become available. Obviously, the training aspect and trying to educate our clients is important. So what I took from Logan's presentation is housing is going to crash, right? Just kidding. The thing I want to point out as a lender with what he said that resonates for me, that people don't understand that is unique to the United States of America, is we have fixed housing costs, right? Where else on the planet do you get a 30-year fixed? I don't think anywhere. Apparently Canada has a 90-year modification though. So what proposition keeps property tax low in California, guys? Prop 13, so we have fixed debt cost on a 30-year fix. We have Proposition 13. And what is a benefit of higher interest rates in the context of a primary residence? Anybody know? Higher tax deduction, right? Everyone talks about how terrible high interest rates are. What no one talks about in my industry, I've noticed, is the fact that high interest rates means a lot higher tax deduction when you're itemizing your deductions on Schedule A. So that needs to be pointed out too. There are things that you can point out to people that get them off the fence, because there's a lot of fence sitters out there. Reminder, Q&A does start at 1 o'clock. Have your questions ready. And this is going to be after we've had a chance to break for lunch and hear our sponsor spotlight. And I'm going to introduce Steven real quick. Oh, hey, show of hands, who here has worked with JMJ Financial? I actually closed a transaction with JMJ Financial before. Okay, so this is my ask, the QR code on your table. If you're feeling generous, give us a Google review, please. All right, Steven Thomas. So I've been in the industry since 2004. I struggled for a long time. But when I finally got a real estate office to say, sure, you can come present, I said, are you sure? Ooh, I don't know. They said, yes, I'm sure, come. Well, I didn't know what to share. And so I scrambled and I saw it. And what I realized was we had a local housing analyst, and his name is Steven Thomas, with reports on housing. He literally saved my bacon. Because before those sales meetings when I was a younger man in my 20s and completely terrified, I came prepared with Steven's data. And it's really cool. I don't know if you guys get his text messages every week about demand, up or down, inventory up or down. It's nice to be able to know in real time what's actually happening, similar to what Logan offers on a national scale. We got to be educated, guys. Can't just be salespeople. We have to educate. So I guess what I'm saying is, Steven, thank you for saving my ass. I do appreciate you, and we're excited to hear what's going on in the local Southern California marketplace on and beyond what we've heard from Logan. Logan, thank you so much for your presentation today. We're looking forward to the Q&A panel as well with you both. All right, Steven, here you go.
Thank you. Appreciate that. I love following Logan. We've gone way back for about a decade now. But anyway, let's start with some fun photos really quick, just a few, because to get some levity before we dive into my part of the presentation. This is an MLS photo. This tells you what a disaster turning your half bath into a 3/4 bath might look like. Don't do it. That too. That's called functional obsolescence. That is a bathtub. It's like gross. Who's laying in that bathtub? That's another disaster MLS photo. This too, an MLS photo. Not going over to this person's studio ever. And in the month of November, 2 agents said, I have one that just looks just like this. So there's more than one. Creepy person. I put this into my funny photos. Logan will get a kick out of this. This is Melody Wright. I did this during Thanksgiving because she said home prices dropped by 50%. She's decorated with a lot of different credentials and stuff like that, but it's not in analytics or economics or anything like that. And she said 50%, but later on she changed. It's like, I think 38%. She's looking up and to the left because she's an English doctorate. She was making it up. So, and if you go back a year prior, at the end of 2024, she said 2025 housing bloodbath. Or 2 years prior, she said worse than 2008, the ultimate housing bubble, worse than the GFC. There's just one more. That guy's name is Adam. We know them all as the doomers and gloomers, but they've been wrong for so long, and they don't really follow proper analytics. I get up many days, I just want to go toe-to-toe with them, but
I've debated Melody twice, and she's terrible.
She is terrible. She makes things up. Everything is what she hears and sees on the street, which is a bunch of garbage. She doesn't believe any of the data and stats. So there you go, one of those. So really quick, I know you guys know who I am, but introduction, just to quantitative economics, decision sciences major, UC San Diego, been in the business forever. Orange County native, Capital A High School grad, 9 kids. One of my kids is here, Brennan. Brennan, stand up. He made me do a podcast 2.5 years ago. I said I won't do one, and then I did one. So we've been doing it every other week. We're not like Logan. We don't do one like five times a week. Who has the time for that, Logan? I have too many kids. So there you go. Reports on housing, your local real estate snapshot. That is what we do. I'm a housing analyst. We are housing analysts. People say, what is a housing analyst? It is fun. It is fun. We're all about setting expectations, and so are you. So what we do is we try to empower you to properly set expectations, because everybody has this theory about what's going on, and it's oftentimes wrong. We don't focus on closed sales data. I'm not a big fan of talking about it because I like talking about what's going on today, and that's supply and demand. Available number of homes to show your buyers today. Supply and demand is a snapshot of the last 30 days of pending sales activity. From supply and demand, we do our math and we came up with expected market time. I did this in the 90s to properly set expectations of my own buyers and sellers back in the day when I represented buyers and sellers. And people go, I don't understand, yours is so much higher than the market. Yeah, because it's slow out there. It's not a 30-day expected that a seller should have expecting to go into escrow. This is our expected market time going back in time. And if you see, it started in 2004. In 2007, this thing hit 500. And the reason for that is all of a sudden we came to a complete stop. And it wasn't long because we had some government intervention, things like that this thing started to drop. But there was an instant where you knew something major was going on and you could see it. At the same time that our expected market time was way up here, the average days on market was less than 90. So you did not want to tell anybody during that time period that it was going to take 90 days to sell their house, because nothing was selling and everything was coming on the market faster than demand as demand was dropping. And then in 2012, our expected market time was well below days on market, which again was in the upper 90s, and it was a really good time to purchase. And then same thing happened during COVID. It was better than days on market. And right now, it's worse than days on market. Why? Because it's really slow. Because it's an absorption rate. When we see homes come on the market and what we see happens in pending sales activity, we do the division and come up with the expected market time. It's the true speed of the market. Place your home on the market when you open up escrow. I hate days on market. That's why I came up with this, because days on market is a horrible statistic that we all rely on because we've been spoon-fed it since we see average and medians from the MLS. And we have reports now that all over SoCal, Bay Area, Vegas, and Phoenix. It's been fun. It's been totally blowing up in Vegas more than anywhere else. And then so far, a couple of our reports this year slow out of the gate. We talked about it being slow, but it's going to heat up. And then Prepare for Launch is the one that came out last night. So this is just, I know from here it's going to get extremely busy, but those first 2 weeks were actually not that busy. I'm a nerd, Logan's a nerd, my son's a nerd. We are nerds. We love what we do. Our junk food of choice is actually statistics and economics and hearing what people have to say about what's going on. We have an economic model we follow. It's a progression model because things are constantly changing and evolving. So we're going to dive into the housing market. There are 5 seasons. And we just got out of this one, the slowest, the holidays. Spring is the best in terms of demand. Even in the snowbird states, it's funny, there's a number of homes that come on the market in August and September in like Phoenix and Clark County, Vegas, and they're wrong. That's the wrong time to be coming on the market, and their market really slows. But spring is the best in every market, and then it's summer, then it's fall, then it's winter, slowest of the holidays. Holidays is done once we get to the middle of January. We are in the middle of January. It is done. Now we go into the winter market, and that's where supply rises. And it rises at a little bit faster rate last year than the 2 prior years. And I think this year might rise a little bit faster, just depending upon what happens with rates. But demand is going to surge right now. And it's because these are really favorable interest rates as well that we will see a real surge, and people are going to wonder what in the world is going on. Now we're going to talk about housing inventory. Logan brought this up, and this is National Association of Realtors. This thing goes all the way back to the 80s, but I stamped this back to 2022 because this is what doomers like to do. They like to show you that was 2022 and look at the direction of housing. My gosh, we have so many more houses. We almost have as many houses as we did in 2019, which is ridiculous because this is that same white arrow. And it's taken out of context. And that is what they do more than anything else, is take everything out of context because they don't know the context because they haven't studied this for decades. And like I said, this goes back to 1982. This was Logan was talking about, the 4 million homes from 06, 07, 08. And that up there is called a supply glut. That is, we had way too many homes. This is the number one reason we are not going to crash in values, is because we still don't have enough homes, because you need to have a lot of homes. You need like 3 ingredients for crashing values, and you have to have all 3. And we are missing one of the main ingredients, and that is way too much inventory, that supply and demand scale. So when we hit 4 million homes, we had 18,000 homes here in Orange County. We have not anything close to that right now. And this is where we are right now. You draw a line across. This is called supply scarcity. This is what we've been dealing with. Yes, it's a lot more than where we were in the last few years, but I don't even want to go back to where we were a few years ago. It's like what Logan was saying, very, very unhealthy. Now, I've been stalking this family, and there's a lot of Shutterstock photos of them, and I've used them all up, but they did everything right. They got married, they bought a house, they had babies. They, you know what, they refinanced during the COVID years, and now they don't have enough room in their house. They're doing everything on their porch. And this is that locked in thing that he talked about. I don't call it locked in, I call it hunkering down. They enjoy going to Cancun 4 times per year and this great cash flow that they have. So they really don't want to do it. Can they do it? Yes, they can. But there will become a point where, gosh, you know what? We're tired of doing everything on their porch. I don't care about this higher rate. We're just not going to be able to go to Cancun 4 times per year. Instead, this hunkering down thing, in California, this is through the 3rd quarter of this year. National Mortgage Database was released it was right during Christmas time. I thought it was a total present. It's a giant spreadsheet that you download. And from that, it's 77% of all Californians. Now, it's 31% of all Californians own their home free and clear. 40% across the United States. We have a few more mortgages, but we also have a lot of people that have 3% or lower mortgages. But taking into context everybody that has a mortgage, 77% have an interest rate of 5% or lower. Last year when I was doing this, it was at 80. So it's going down, but it's 77 now. It's 62% have an interest rate of 4% or lower, and 28% have an interest rate at 3% or lower. This has gone from 30, last year was at 29, now it's at 28. It's not falling like a rock, but there are people that are exchanging their less than 3% mortgages for a new home. So who in this room has an interest rate of 3% or lower? That's a lot of hands. Good job, Jason. So that's a lot of people that have low mortgages. So out of those people that just put their hand in the air, who's thinking about moving in the next couple of years? Let's see if anybody will be vulnerable. Somebody's thinking of it, every room. This is a lot of people. See, thank you for being vulnerable. I appreciate that. So people are thinking, yeah, you know what, I still want to move, and I'm sick and tired of waiting because it was August of 2022, the last time we had interest rates below 6% for any kind of duration. That is forever ago. That was like 41 months ago. So that was a long time. Now, we're just tired of waiting. And you can see this in the data. Now, this will explain to you why we have increased our inventory here in SoCal and specifically Orange County and across the United States. This was 2023. That green is the 3-year average prior to COVID, 2017, 18, and 19. That blue is 2023. Nobody, there were people that placed their homes on the market, but very few homeowners placed their homes on the market. And as a result, this supply and demand, even though we had interest rates that went skyrocketing higher, and they even breached 7% in 2022. In 2023, they were up there as well, and they got all the way up to 8%. And people also didn't place their homes on the market. We had demand that was low. So if you take that supply and demand scale, there was actually there was fewer homes available, and demand had really come down. But that supply and demand scale meant that we still had prices going up, even though we had interest rates that were as high as they were. So all it has to do with supply and demand. Now in 2024, that's the purple line, we had more homes come on the market than 2023. Now, it's the same amount of demand. Demand did not change. People said that the buyers are starting to go on strike. That's not true. That is not true at all. They continued to purchase at the same clip because we were stuck between 6.5% and 7.5% interest rate, that interest rate purgatory for a very long time. And so demand wasn't changing, but now all of a sudden we were placing more homes on the market, the people that were tired of waiting. And so what we did is accumulated homes, and our inventory started to grow. And in 2025, last year, you could see a lot more homes than 2024, way more than 2023, and demand still wasn't changing because of that interest rate purgatory. And we saw that our inventory really skyrocketed last year, and that's how we got all that extra seller competition, because those extra homes that were coming on the market just accumulated over time. And you can see we closed out the year, there was so much negative news on housing that it actually started following 2024's line. And the only reason why it did that is because we had fewer homes that homeowners started placing their homes in the market because they said, I really don't have to sell. Because not that many homeowners really have to sell, which is the second ingredient that is missing. So you could see that last year, 2025, we had 2,100 extra for sale signs compared to 2024. And compared to 2023, it was 25% more, 5,800 extra for sale signs. And those just accumulated. We're still missing for sale signs. We're down 26% versus the 3-year average prior to COVID, which is missing over 10,000 for sale signs. Now, if we had them all come on, they would be matching that similar demand, and our inventory would go up like crazy, and then we'd have a disruption in prices, but that's not what we're seeing. This is the Orange County active listing inventory. This is the only one that I have locally that goes all the way back to 2004, and it shows you that we had 18,000 homes in 07 versus where we are right now. This is starting our year. If you can see, there's a little needle here. That is the beginning of 2026. And there's 2026. Now, normally we don't get this kind of a jump at the beginning of the year. The reason we're getting this kind of a jump is because there's a number of homeowners that placed their homes that pulled their home off the market, delisted during the holidays, and placed their homes right back on the market during the first 2 weeks. This is a phenomenon that started 2 years ago. We had more people pull their homes off the market this year, so there's even more that came on within these last 2 weeks. So that's where we are right now. And you could see that 2025, that red line, and you could see the blue line, that was 2023, we couldn't build an inventory. So that supply and demand, that's why prices went up, because we didn't have a supply. In 2024, more homes participated, more homeowners, so we had more sellers. And in 2020, that's 24, 25, the red line, you could see we really built some inventory last year, and we were making our way back up towards the 3-year average. Incidentally, Orange County is the furthest below the 3-year average prior to COVID. LA market is actually above the 3-year average. So they're slower in Los Angeles. So today we're at 3,062. This is from the report that just came out, up 13% or up 359 homes. And last year we were at 2,759. That is 10% fewer, 303 fewer homes. And 3-year average prior to COVID is 4,640. We're missing a lot of homes. That's 52% higher than where we are today. And this is where we typically peak every single year. Last year we peaked here between July and the end of August, but the couple years prior, we were peaking later in the fall because we had higher interest rates in the fall. This year, we had a break between September all the way to the end of the year. We were below 6.5%, which was fantastic, and we're still there. And you can see where we're going to go is we're actually going to go flat over this next couple weeks, and the reason for that is because now demand really picks up. And we had everybody that pulled their home off already relist. Everybody said there's going to be a ton of people that relist in the spring. That is some theory. I don't even know where that comes from. It's like people make things up in their head. Yeah, there will be a lot of people that come back up on in the spring, but there will be a lot of people that won't because they were on the market for 6 months and they don't want to do that again. Keeping their house clean over and over again, having their homes shown, and they're not getting their price. So that's where inventory is going to go. Where those lines go really depend upon what happens in rates. Now we have low demand, and I've been praying for something for a long time. I've been getting down on my knees every single Sunday, and every day I have this prayer. And I pray for 6%, exactly 6%. I actually don't want to get into the 5s right away because then we'll have unhealthy entry-level price ranges, that's $750 to $1 million locally. It'll be all the millennials and Gen Zs that will enter the market because finally we have the 5 handle, and it will really it will drive prices up too fast. So I don't want to get there till the second half of the year. I like to take baby steps in getting places because I like economics that's slow and boring. That's fun for me. So there you go. But this is where we have rates today. By the way, our rates, this is thanks to Greenland. This was dumb because I finally got my 6%. I was so happy. People were saying, hey, you got your prayers, because we need 6% to match up with our winter and spring markets. And we're still between, we're well below 6.5%, which is good. I just like 6. I just want that for my millennials and Gen Zs. But because they've been taking it on the chin over and over again. Yeah, they've been purchasing, but they've had to compete with Gen X's and baby boomers, and it's been awful. So anyway, this is where we are right now. This is what we had. This is normal. This is actually a normal looking fall of prices of interest rates from May. We were up above 7% all the way down here. And that looked normal, felt right because the labor market was breaking. All the data showed. The year prior we got there, and it seemed like we shouldn't have gotten as low as we did. This time it made sense. Now who knows where we would have ended up, because during this time we went sideways for such a long period of time because we had no data. How was that, Logan? Did you like not having data? That was awesome. We loved having zero data because the government shut down forever. But this is where we are right now, 6.21% as of today. That was that jump. We were at 6.06, now at 6.21, thanks to Greenland. There you go. Interest rate impact on affordability. Now I show this slide because we are in a high cost area. By the way, it takes about $7,000 per month with 20% down to afford the median sales price home. At 7%, we're at $1,315,000 of a house. This is just principal and interest, 20% down. Now, you could see at 7% it's $1,315,000. At 6%, it's $1,460,000 of a house. Every 0.25% that it goes down, your buying power goes way up, and especially in the high-cost areas like here. So if you're like looking at $7,000 a month, go, oh my gosh, that's expensive. That's where we live in Orange County. It's very, very expensive. Everywhere else I put $5,000, but in Orange County, you guys get $7,000 per month. And that's what it is. But you can see the reason why I don't want to go to 5.5% yet is because we're at $1,541,000 for a house. That's going from $1,315,000 to $1,541,000 in a short amount of time is crazy, and it will open up the floodgates for buyers, especially in the entry level price ranges. $750,000 to $1 million will get hit. So that's what I'm not rooting for. Later on in the year, I'm fine with that. Let's do it in the fall. The highest mortgage rate U.S. homeowners say they'd accept on their next home purchase This is Resi Club. Besides listening to Logan and all this stuff, I like listening to Lance too at Resi Club. He's left, where was he? Fortune? So he left Fortune, and this is a survey. Take a survey with a grain of salt, because who in the crap even fills out a survey or talks to somebody that calls them for a survey? Who's even answering the phone unless you recognize the number and it tells you exactly in your database who it is? So at 7, this is the first quarter, is the blue, red is the third quarter. This is the highest mortgage rate U.S. homeowners say they'd accept on their next home purchase. They'd consider moving. At 7%, only 14%. At 6%, it climbs to 52%. At 5.5%, it's down 66%. So you can see a lot more homeowners that are locked in would consider making a move. So obviously not locked in, right? Orange County demand. Now this is, each one of these is a year, and you can see this triplet right here, I hope to break free of it. This is just low, what I call inherent demand, 2023, 2024, 2025. It is that triplet on the right. Now, if we get rates that stay right around 6%, this is actually going to bump up a little bit. Won't go back to where we were prior to pandemic or even during the pandemic, but it will be higher than these last 3 years. Just we need to keep rates at where they're at during our winter and spring season. And we haven't been able to do it. The last 2 years, last year we were never below 6.5% during the spring, the year prior to that also, for just a brief period of time. But this is where we are right now as far as Orange County demand is concerned. Now, because demand actually did a Los Angeles thing, and it's never done this in Orange County. And demand actually during the first 2 weeks, because we snapped it on January 1st, just happened to be that Thursday. 2 weeks later, it was January 15th, and it went down a little bit. So demand actually, I heard from people that said they placed their home on the market and they're wondering, how come I'm not getting an offer? And that they weren't alone. There were a lot of people, because I told them, still the holidays. People are still at the gym on treadmills. You have to wait till January 16th for them to get off their treadmills. They no longer want to go. Their New Year's resolutions are done. Today we're at 914. That was down 4% or down 37 pending sales. And last year we were at 988, up 8% or up 74 pendings. And if the 3-year average prior to COVID is the green line, we're supposed to be at 1,634 right now, which is 79% more, 720 extra pending sales. So yes, slower than what is normal. And Orange County demand year over year. Now demand typically peaks between April and the end of May, and we're starting off over here. This thing's gonna shoot higher, which is why I wrote that report, because this is the same thing we do every single year. We get to Super Bowl and you guys say, this is the best time to come on the market. You guys say it all the time, Super Bowl, best time to come on the market. Do you know that Super Bowl moved a week later? So that happened and you were still saying Super Bowl. It's actually closer to Valentine's Day is the speediest time in the market. Now, based upon supply and demand, I come up with the speed of the market. That is expected market time. Place your home on the market. When you open up escrow, you can see that, look, there's my bad boy right there again. 500 days, that's a long time almost. This is where we are right here. This is what Logan was talking about. For 2 years, we were in the teens, right around there. That's ugly. Or right around the teens. That was, I don't even have it on this chart because now I go back just a few years. I love getting that off of my chart, 2022. But you could see that the expected market time actually went way up in this last report. It did it last year, it went up a little bit, not normal. This year, even more. And that was all the extra homeowners coming on the market all at once that delisted. There were more of them in 2025 than there were in 2024. So that's why we got this big bump in the expected market time. People were going, what's going on? So it actually went up, is at 101 days, up 16 days in a 2-week period of time. Now this thing is gonna fall like a rock, but those first 2 weeks, you felt it. This was everybody else competing against each other, and demand was actually going down when all these homes were coming on the market. So last year we were at 84 days at this time period, and the 3-year average is 88 days. That's the green line. Now this is where the expected market time typically is the best. It's actually right around March 1st, not Super Bowl. It's March 1st. So come on the market, and I always say if you're luxury, I come on the market right here. right around the end of February, best time of the year to come on if you're luxury. I know that luxury thinks that they could do whatever they want. So come on the market in August and September is dumb. That's dumb. And I can write reports for your specific sellers. I charge a custom fee to write these. I will not call them dumb, but this is what's going to happen in the expected market time. It is just going to fall like a rock right now because we have all this extra demand and supply won't change much. Supply will not be able to keep up with the amount of demand because that's not when people come on the market. In Orange County, they don't come on the market. They start to second half of March. January and February are not months with a lot of homes coming on the market, just those initial 2 weeks from people that delisted. So the market for the most part feels a little sluggish. I call it a buyer's market. That doesn't mean that prices are falling. That just means the buyers get to call more of the shots. And that's what's going on right now. Some areas and price ranges feel a little bit more balanced. Some homes feel hot. Now, I've done this at many audiences so that you can educate your sellers as well so they understand this. We actually have a report that comes out that Brennan put together. It's the closed sales report. It's the sold report. It comes out once a month. And that it's a separate report to the every other week report that comes out. And in that, he shows how many sell above the asking price. There's a lot in Orange County that sell above the asking price. And people are going, well, I thought this was a sluggish market. So what happens is that every buyer is connected to has the app, and they're looking at everything that comes on morning, noon, and night. And they look at the virtual tour, every single photo. Then they look at price because they know value. Because they are really smart in their price range. They understand things. They're very intelligent when it comes to that. So when they see something they like, they contact you and then they go see the house. And they go, yeah, I want to write an offer. They write an offer. The problem is those kind of wow factor houses typically have like several people that do it. Let's say 4 more people go do the same thing, write an offer. Now you have 5 offers and you have 1 seller. Who's that work out for? Remember that supply and demand scale? It's the seller that wins. It's just supply and demand. There's 1 seller, 5 buyers competing against each other. So the rest of the market doesn't feel that way, but that house certainly feels that way. So then now you have to tell your client, you have to go above the asking price. Well, I'm not going above the asking price. Well, you're not getting the house. I'm sorry. Sorry, you're not getting it. You need to meet with Jason Thibodeau, and all the different reps here will sit down with you, and they're going to sit there and they're going to go, hey, if you go $5,000 above the asking price, this is how much it's going to cost you. It's about, what, $25 a month or something like that, $30 a month? And then you ask them, do you have a Starbucks app? They're going to say, yeah, I have a Starbucks app. Yeah, does it reload? Yeah, it does. Yeah, at $25. Well, that's pretty silly. Why don't you pull that off and buy yourself a house, right? So that's what we got to do. So they didn't understand what's going on. That's why we put together the closed sales report. This is our expected market time sheet for every single city, and it has the available number of homes, demand, last 30 days of pending sales activity, expected market time. What was the expected market time 2 weeks ago, 4 weeks ago, 1 year ago, 2 years ago? So they can get context. That thing that we talk about, things taken out of context, they need to understand where we're at. And this is Huntington Beach. I don't expect you to see it. So instead, I'm going to tell you, Huntington Beach last year was at 119. This year's at 116 right now. This is the slowest reading we're going to get. It's only going to get way hotter from here. But here we are. We're at the beginning or middle of January. It's going to change from here. It heats up. Don't worry. You'll get Super Bowl and go, now it's great. Yes, because that's what the market does every single year, regardless of what kind of economic situation we're in. Fountain Valley is at 87 last year, is at 90 days this year. Westminster is at 50 last year, is at 60 this year. Seal Beach, 64 last year, 109 this year. Costa Mesa, 53 last year, 102 right now. Garden Grove, 93, 74 right now. Newport Beach, 189, 205 right now. Los Al, 63 last year, 81 this year. Cypress, 56 last year, 58 this year. You guys get the point. You need to know exactly where you're going to understand what's going on in the marketplace. A lot of this has to do with price ranges as well. And then Santa Ana, 78 last year, 128 right now in Santa Ana. There you go. Who knew that? I didn't. So that's why I rely on my housing report in order to tell you what's going on. My market overview, this is luxury. Your regular luxury is at this is 2.5 million. We graduated there 1 year ago. We're now 2.5 million. It's the top 10% of the market. I had to make a whole new price range for this, but we did. And now we have year-over-year data finally, because we're patient, and it finally comes. Inventory is at 699, which is 5% less than last year, 38 fewer homes. And last year at this time, right now we have 105 pending sales, last 30 days pending sales activity demand. That's up 8 from last year. So the difference is expected market times at 200 versus 228 last year. So even though the overall market is actually slower than it was last year, the luxury is a little bit faster. And this will dip down. It's going to go down from here. 200 is high for luxury here in Orange County. But you need to know your different price ranges. We do attached versus detached, and for some reason, we had a whole bunch of detached homes come on the market at the same time, and our expected market time blew up from 83 to 105 in the last 2 weeks, and the attached condos went from 89 to 90. So what's been going on is actually detached has been hotter than attached, which is not normal. And it's like this across the United States. But Orange County has been doing something a little bit different. Every once in a while we get this where detached is slower than attached, which is like it was normal. But that's because of the lack of inventory here in Orange County compared to other counties and across the US. So, but this will go back to where attached will be slower than detached again later on this year. They'll duke it out. And this just shows the difference between detached and attached. It actually, during part of this year, you could see this is attached is the green, and that's detached is the red. So that's where it was, but then it went below it. So for quite some time, in many markets, it's well below it, the detached versus attached. And then Orange County luxury closed sales, the number of closed sales last year is up 8%, up 173 closed sales. That's 2.5 million plus. And Orange County closed sales, all price ranges, is down 1%, down 173. So basically, we sold the same number of homes between 2024 and 2025, which is way less than we normally do. And this is that report that I told you that Brandon puts together. This is the Orange County closed versus last price breakdown. Get this in front of every single one of your buyers so they will know that they might have to go above the asking price. So those people that are looking for a deal and will not pay the asking price, they're excluding a big portion of the overall market because only 60% sold below the last list price. So that means that 40% either sold at or above. They need to know that. That's a lot. They're basically excluding a giant chunk of the marketplace. And sold at the list price, this is December's numbers, by the way. It's 15%, and sold above, 25%. So a quarter of all homes sold above the asking price. Do they really want to exclude 1 out of every 4 homes that comes on? Probably not. So this is why you need to get this in front of them so they understand that, yes, things sell above the asking price. Not crazy, but it could get crazy if we had interest rates in the 5s that match up with their spring, which is not what we want. And then the numbers that were cash is 27% in December. And I know everybody thinks there's tons of cash. Actually, cash doesn't change much over time. We're just doing fewer units overall sales because of how high mortgage rates are. So it just becomes a bigger piece of the pie. It'll be a smaller piece once rates continue to float down. And then this just tells you, this is Zillow House Price Index. I found this. This is great. This is golden. I love using Zillow. I'm using them for free. You too, research Zillow research data, and you get their sites. You can actually, they forecast every zip code as to where they are from December of 2025 to December of 2026. You can download it right now. Because you have clients that ask you where price is going. Well, according to Zillow, and who cares? They pay for nerds like me and Logan to go man their shop over there, and that's what they do all day long. So I'm going to tap into those nerds. Who cares what? They've taken advantage of us. Now let's take advantage of them and let's download their stuff that's free. And this shows you what Orange County and LA used to be lumped together in everything except for Zillow's. And this shows you what's happened over last few months. Because interest rates have come down, we have values going back up over the last few months. October, November, December. No surprise to me, no surprise to Brendan or Logan. It's down 0.2% year over year, which means nothing. That they went nowhere. but it went up at 0.5% month over month. That's the trend I'm watching. This is if we have rates at that 6% or very close to 6%, which is where we've been behaving. It's just a demand and supply things. Over the last few years, we built this inventory because we've added more and more supply. More supply in 2024 than 2020, way more in 2025. So that supply and demand thing, demand wasn't changing. We just kept on adding more to the supply, so the market was slowing over time. And then, but we get these interest rates below 6.5%. Now all of a sudden we add more demand, and it's kind of making this better balance. Now, if we get into the fives, that demand just crushes the amount of inventory that we place on, and it will be a different marketplace. I don't want to see it. That's why I'm not rooting for it. Bullseye pricing. We have to be so careful in pricing. Spend an hour, 2 hours, 3 hours just coming up with price. I would send them twice a year. We do this thing called net less. And it's disguised as different reports, but basically it tells you when you reduce the asking price, you will net less. And we can statistically show you that. The more you reduce, the less you net. And that's according to the last sales price, and you're on the market forever. So don't reduce your price. So you send them that net less the night before, and then you sit down with them and you have an intelligent conversation about pricing, not what I feel my house is worth or I love my house. Who cares? Let's talk about the stats. Let's make sure that you net as much as you possibly can so you can go do what you want to do, and then you sell your home. And then you earn a commission. So that's what it's about. Reduced pricing right now, as of right now, 31% of the entire Orange County database that's available right now has reduced the asking price at least once. And this is through December. Brendan keeps on updating this regularly now for me. I love this. This is for December. I haven't even seen this because he just updated this. Out of all the closed sales, 66% of all closed sales did not reduce the asking price. And we took the sales to last price ratio, and then we took the median of all those, and it's 100%. They got their asking price. And they were on the market for 12 days, which means that $1 million home got $1 million. Now, if they reduced it between 1% and 4%, which was 16%, they got 98.1% of their last price. Which means that if the $1 million home now got $981,000, they just threw away cash. How about 5% or more, 19%? That $1 million home, now $974,000. They're throwing away a lot of cash. That was dumb. They should have been priced right to begin with, and they're on the market for a lot longer. That's the point. That's why I repeat this thing over and over again. It doesn't even matter the price. People think it's just the upper price range. Not true. It is all the price ranges. That's what we look at, and this is what it shows. And so a lot of stuff ends up overpriced. So know that. Who has an overpriced listing in here? Just two? Brennan, hold up that bad boy. We had this thing, yeah, it's gone now. Yeah, overpriced. You guys can have these made too. And I'd sit down with your clients and talk to them about Steven Thomas from Reports on Housing told me to bring this and show you that we don't want to end up overpriced or we will net less. Remember that thing I sent to you last night? That type of thing. We have to have an intelligent conversation regarding price. Now, the number of homes that delisted, there we are. You can see in December it spiked like crazy. We're up 64%, up 3,286 extra homes that we pulled off the market last year compared to 2024. And then we'll get into I'm going to tell you why we're not crashing. Okay, we're not crashing because there are three things that you have to have in order for home prices to crash. One of them is a glut of homes available. We don't have that. Another one is low demand. We have that. The third one is you have to have people that have to sell. And we had that during the Great Recession, that third one, and that was in distressed homes, foreclosures and short sales. In the month of December, we sold 3. In 2019, at the same time period, 19. Over here, over 1,200 on a monthly basis. That's what we're doing in Orange County. So we're nowhere close. My 2026 forecast, and then we will go have lunch, so I don't quite know completely. Nobody knows completely exactly where we are going, because I didn't know that the administration was going to say that we want Trump and we want out of NATO. We want Trump, we want Greenland, and we want out of NATO. I didn't know that that's basically what he's telegraphing out there. So who knew that? So my 2026 SoCal forecast, though, we have 3 scenarios. I'm just going to give them real quick. If scenario 1 is the economy continues cooling to start 2026, rates remain between 6 and 6.5% with duration, which is where we're at right now. This is our base case of where we are going to be. Closed sales up between 5 and 7%, and home values in 2026 up between +1 to +3. It just depends upon where those rates go. And then the second scenario, which is not as likely, but let's say that the labor market breaks to start 2026, because it has to match up during our winter and spring market. Let's say February's report, first Friday of February for the month of January, shows that labor market broke. All of a sudden, you'd see rates fall, and if they fall any more, we're going to get below 6. So now we are at 5 3/4 and 6% with duration. That's closed sales up between 8 and 10%. And home values in 2026 between up 4 and up 5% year over year. I'm actually not rooting for this because that will be at the expense of millennials and Gen Zs and an unhealthy entry-level price range. And then my third scenario is economy resilient start 2026, rates stuck between 6.5 and 6 3/4 with duration. Now we're above 6.5%. This is if the labor market strengthens. Now, buyers not willing to stretch. You have closed sales between down 1 to up 2%, so nothing really on closed sales front. And home values in 2026 between down 2 to flat. So I'm not rooting for that. That's getting less and less likely. But if we keep on seeing that we want to purchase Canada and we want to purchase Mexico and we want to purchase all that, might affect things a little bit. So I have a weekly text message that comes out every Friday, even in between reports. You have to be a subscriber to get these. You have to opt in on your first report. We have an Orange County monthly sold report that's part of it. And we have a lease report that we started as well because I think it's 12% of all people that delist want to rent out their home and become a mom and pop landlord. So you need to know this. That's why we put this thing together. And reports, analysis, and your comments where you go to subscribe. It comes out every 2 weeks, and we have a lot of ways to repurpose it. And it's $20 per month or $200 per year, and you get them on free. We have these. Brendan will have these if you want them. He'll pass them around during lunch. You fill it out and get it back to me. We'll get it to you later on today. Thank you very much. I appreciate it.
Do I have your attention? Do I have your attention? I'm so sorry to interrupt. I do apologize. We do want to get you out of here at a reasonable hour. As soon as we're done with the sponsor spotlight, we are going to do a Q&A, so have your questions ready. Who are we doing a sponsor spotlight for? All right, we ready, guys? We ready? Hi. So we're doing a sponsor spotlight for our main sponsor, On Demand Escrow, an independent escrow company in Huntington Beach, California. Happens to be my lovely wife. We're also doing it for us, J&J Financial, your Huntington Beach branch. So what is escrow? It is a neutral third party, right? We've all heard that term before. Now, neutral third party depends on the nervous system of your escrow officer, right? I don't think people pay attention to the human experience when it comes to transactions. And what makes my wife so exceptional? Well, when there's a difficult transaction, I know those things, can you believe it? It happens in real estate, difficult transactions, difficult personalities, complicated situations. And when you have a difficult seller or an abrasive personality in general, regardless of who we're talking about in the transaction, how we respond, it's not just our excellence with our technical ability, because my wife is one who is hired as an expert witness in upper echelon cases and escrow cases and real estate cases. It's one thing to have technical ability, it's another thing to understand the power of stimulus versus response and our power to choose our response. And so when realtors experience her for the first time on the buy side, they're like, okay, wait a minute. Why aren't you being difficult? We all know a good escrow decides the transaction in many cases. We all know marginal or even below average escrow decides a lot of other things. So you need good team players, and yes, the elephant in the room, that's my wife, I'm biased, I understand. But at the same time, I've been able to see her perform for about 22 years now, and she's always calm, cool, and collected under fire, even better than me. There's a reason I lead and don't originate anymore. That's a good segue. Love you, honey. So you're also looking at some loan officers for our branch. Hi, guys. I just want to say that the reason we're at JMJ, I was a broker for 12 years, 2004 to 2016. I thought to myself, all right, I'm going to try a big fancy lender. I did a big fancy lender, bells and whistles, big giant operation, president's club, sales rallies. Wasn't for me. Too much middle management, too much corporate bureaucracy. After that, we found this Goldilocks zone of a direct boutique lender. We talk to our director of credit, Tony Kuda, every single day via email, via text, on a phone call. A rescue escrow panic situation. Tony, help us. Can you run DU? Can you talk to Fannie Mae? Not having to go through the layers of support or call an account executive in Michigan. Can you please help me? And get a marginal answer. For me, I need certainty because we are realtor. We work with realtors. We have to do what we say, and not just some of the time, every time. And that is critical. And so I, went on my journey to find the right situation. I failed on my first effort for the last almost 8 years now. I've been running this show with my partner, and it's grown from just the two of us, to 30 loan officers, 2 branches, multiple states. And I don't say that in ego. It's just like once people understand true suffering in our industry as a loan officer and how difficult and how many sleepless nights and how much anxiety you can be riddled with when you don't have the right support, the right culture, the right leadership. Well, once they find it, similar to somebody realizing with a light bulb going off, oh, that's a really good escrow officer. The same can be said for us. There is no perfect system. I'm not saying you're better than everybody else. Some people will align with us, some people won't, and that's okay. There's 8 billion of us. I don't expect everyone to like me. But at the same time, these are good human beings. It's funny, on the outside of this looking in, they're actually better at being a loan officer than I am. I'm in the role I was meant to be in because I'm a deeply empathetic human being, which is a double-edged sword. It's a good thing and a bad thing. But it's an honor to be able to lead these folks. I'm going to give them an opportunity to share a little bit with you. We're going to jump into a Q&A, and then it's back to work. All right, guys. This takes a lot of courage. They're not used to doing this. Okay, so let's see how they do. Judge them. No, I'm just kidding.
All right, I have 2 mics.
No, use the dented one.
Use them both.
No dented ones.
Thank you, honey. That was a very nice introduction. I don't know if I need to say anything. Okay, bye, guys. It's really cool to be a sponsor. It's really fun to see this event. This is the 2nd year to see all the work come together. So really grateful to be a part of this. Like Jay said, on-demand escrow, independent escrow company. Been at it for 22 years. About 2 years ago, took the leap, opened up my own. And we are family-run, boutique style. I've got my sister-in-law as my right hand. She's my ride or die. There's a lot of love in the office. We really do care deeply about every single one of our clients. Every single one of our transactions is important to us. And we do everything. We do every type of escrow there is. Mobile home, yay. We all love those commercial, business sales, and then of course the resale that we all love and refis. We do it all. So, speaking of transactions, I will now segue. Hey, Mike. Let's see how scripted this is. Hey, Mike, do you want to talk to me about any recent transactions you had that mattered to you recently?
Well, funny you should ask, because it included you, right? So I'm Mike Rambo. I'm a loan officer at JMJ. And I think at the heart of sales, it's about helping people that need the help, right? And this last year, I had somebody who needed a lot of help. They went through a divorce, and the only loan they can get at the time to buy out their partner was a private money loan at 14%. And we tried to do a traditional loan, and the income wasn't there, the credit wasn't there. And I would just sit at my desk going, how is there not a loan in this world better than 14% for this person? We worked on their credits. I found a loan using non-traditional income sources. We had to work with their CPA. It took multiple months to get it done, but we did get it across the finish line eventually. So the story to you is that for the people that need the extra help, that need a little bit of help on the credit side, something that's different from what a bank can offer, that's what we could do. And it did take one last push because you had to help in the 11th hour to get it across the line too, right?
Yes, we did. And that is why I think it is really important that you do have a really good relationship with your service providers, so your escrow, your title. It's really good that you can talk with them about a specific transaction, get some extra help where it is needed. Because in that particular file, that particular case, without going too much into details, we were able to make exceptions bend and help it get to the finish line and on time. Speaking of challenging escrows, Jason, you want to talk about a challenging escrow you've had recently?
Sure, we all love those, right? Hi everyone, I'm Jason Thomas, loan officer on Jason Thibodeau's team. Before I get started though, I do have to disagree with you on one thing. You are a pretty damn good loan officer as well. Who in here has heard of SB 326? All right, fun stuff, right? Everybody's been trying to sort that out for the last year and a half or so, and had a transaction last year where we didn't get HOA docs until like a day or two before the loan contingency is up, and sure enough, there's some red flags on there, right? So it definitely took a village to get it done. It wasn't just me, but in working with the seller's agent, our buyer's agent, also having the owners of our company, not just Tony Kuda, our underwriter, but one of our owners, Ryan, even calling me at 8 p.m. at night, working tirelessly to figure out a way to get this done. And it was extremely challenging. Again, these are new guidelines that not everyone knows how to sort through, and sometimes HOAs and property management companies just aren't really cooperative. But we were able to get it done, and it was really gratifying, not obviously just for the buyers to get their loan, but we had a seller who was buying a property and had to remove their contingencies as well, and so it was a really tricky time. But between myself, obviously underwriting, our owners, everybody, it all came together. It was a testament to when you're facing something really challenging. It's not so much what's actually happening in the moment, but how you respond to it. And everybody in that transaction really stepped up, and it turned into a really beautiful thing for everyone. So I know the condos are going to continue to be a challenge moving forward, but oftentimes there is a path. And speaking of condo stuff, I'm going to hand the mic off to MK, who also happens to be my lovely wife. She's going to talk about some insurance stuff for condos.
Thank you. Hello, everybody. My name is MK Thomas, or Mary Kate Thomas. I own the insurance brokerage Coastal Oak Insurance. So obviously, as you can tell, we are a big family here. JMJ, obviously all the LOs. It's just really beautiful how everyone comes together, and I'm grateful to be included in today as well. So thank you guys for that. But yes, condos and obviously insurance in general in California has been a rough spot for a little bit for us here in California. Specifically condos, we're not only dealing with a condo policy for the owner, we're dealing with HOA master policies, right? We're dealing with lender requirements with those policies. So just a few tidbits that I wanted to share. If you are listing a condo or you have a buyer looking at condos, ask for those HOA docs. Ask if you're listing it, get those HOA docs before it goes on the market. Condos and insurance, there's going to be a delay every time. It's going to be an issue. And I've been lucky enough to help a lot of people, and we get it done quickly. But it's still hard, right? And at the end of the day, if you can be well prepared with that, that's kind of just my 2 cents on it. Is just be over prepared, especially when we're talking about condos in California as well. Yeah, and then, also, while talking about condos, we actually, us up here in JMJ, we have a condo class that is, we will go into your office, come into a sales meeting, and talk about the SB 326, is that what it is? Thank you. And talk about just the different hardships. We have escrow, giving an opinion, LO, insurance, just trying to make your lives easier. So if you guys are interested in that, ask any one of us, and we can get that going for you. All right, and then this being a forecasting event, I'm going to ask Lorraine with On-Demand Escrow, obviously a new journey in the past 2 years. What is on the horizon for On-Demand in 2026?
Hi, guys. Well, very exciting. We have been growing over the last couple of years. We have seen a slight improvement in the market. Ariel and I have built a really nice team around ourselves. We've added a lovely sales rep who's right over there, Natalia, if any of you know her. And we are actually moving our office from our humble little sweet spot over in Huntington, just down the street, to a little bit of a nicer building, double the size and space. We need it. We are running out of room. So the nice part about it is I'm actually going to be right next door to these guys. So we're going to be even closer to each other. They might get sick of me. I don't know. Or I might get sick of them. We'll find out. Jury's out. So very exciting stuff. We have a big move coming up, and we've been doing really well. I did notice during the presentations when the guys were talking about seeing a little bit of an uptick in inventory and increase this year. We've definitely noticed it as well in our office. We've probably seen 3 times the amount of openings this year so far for this month than we did the previous months or even like last year around this time. So definitely seeing an increase in open escrows in our office this month. Speaking of transactions, Mike, you want to talk to me real quick about one of yours?
Yeah, I think we're going to talk about transactions where it just meant a lot to the people that you're working with, right? So I got a call or drive in, and the realtor says that he has a client who's, they were expecting, and the baby came 6 months early. Months, not weeks. Very next day, the loan got denied because we were trying to buy it, right? And I think, we're at a forecasting event with charts and graphs and stuff, and I think sometimes we lose sight on, this is a very human business that we're in, right? So these are people that really, really needed help. He was a VA buyer. We found out what the problem was, we were able to fix it, closed the loan in 14 days. So, when you need to move fast, particularly with veteran buyers, I definitely have a big heart for them. This last year, we helped get a condo complex VA approved. It was for a builder who had their own lender. They couldn't do it, so we did it. And that same file, we did a manual underwrite as well. VA loans are so different. Not a lot of people do them. We do them, we do it well. MK?
Yeah, so obviously the insurance world is a little bit different from the lending world. We moves very quick, right? You spend a lot of time with your lender and your realtor on a transaction, and you really get to know them, and then you're in escrow, and then, hey, call this insurance person, you did insurance, and we could talk for 10 minutes and I have a policy and it's bound, right? So a lot of the times the transaction is very, very quick. But I just like to emphasize that at Coastal as a broker, we not only have options, and that's great, and that's what you need right now, but we do take that time to get to know the client a little bit better. Do they have kids? Do they have dogs? Do they, what's important to them? Let's protect their assets and what matters most to them, not just that brand new house that they need a policy for. So just something, and with that said, being so many transactions that happen, honestly, right now in the market, I'm like the least salesy person you'll ever meet. I'm really just honest, and if I see a policy and I can help you save money, I will. If I see a policy and you're in a good spot, I'm gonna say keep it. So just one that I'll share recently is that I had a client, or not a client yet, I had quoted them when they got into escrow. We weren't as competitive, they found something else, great. Their renewal came and their premium went, I think it was like $2,200 a year, and the renewal came in and it was almost $8,000 the following year. They remembered me. I said, hey, save my number as MK Insurance at renewal. If your rates go up, give me a call. They did that. I had a carrier that wasn't open in their area initially. It was open at the time of renewal, and I just found their policy for $2,800 versus that renewal. So, thank you. So that's kind of just my point, is like, it's important to have good people in your pocket. Sometimes it's for immediate, sometimes it's down the road. But yeah, thank you guys. And then pass back over to Mike. All right.
So I got a very important detail in my story. The baby's okay. Mama and baby are happy and healthy. It all worked out perfect. They got the house.
It's like, yeah, just to echo what Mike said, I mean, this is a very human business. It's not all about just seeing how many loans you can close. A story that I have, this was back, I think, during COVID, and had an elderly homeowner. Our property was free and clear, and the family wasn't sure how they were going to afford in-home care. And then going into a home, like it was just, they wanted her to be home and have her quality of life and whatnot. So again, no mortgage on the property. We ran the numbers, interest rates were super low, and it made sense that they could do a cash out refinance with her retirement income. And that bought them a couple years, while the balance of the money each month is just sitting in a money market account to help offset interest. And it allowed her to have her, still have her home, be in her home, and have as much quality of life as possible. And that was something that, you take a step back and you're like, you're actually adding a lot of value to people's lives in certain instances. And it's not just, these aren't transactions, these are human beings. And that was something that, I felt pretty good about. And on that note, Lorraine, I believe you're going to wrap us up here? All right.
Hi, everyone. Thank you. Now I'm going to hand it to my husband.
Oh, well, come on, they did great. Can we give them a round of applause? Thank you. Sometimes it's tough to sell yourself, but when you can actually cite real-life examples where you genuinely helped another human being, it's a little bit more real that way. On the condo masterclass that they were referencing, it's approved by Orange County Association of Realtors. We've done courses for them. We don't have it accredited yet for continuing education, but we're working on that. So just throwing that out there, if you want that condo masterclass, we can do it. Write this down. Is my condo approved at jmj.me? Is my condo approved at jmj.me? What does JMJ stand for? I got a question recently from somebody on my team. Hi, Adriana. Jesus, Mary, and Joseph. I have no idea. It started in 1992, and I was 9 years old then. So, don't ask me, but it's pretty cool, right? All right. So what they will check, because, when I was a young landlord officer situation, hey, is this FHA, is this VA approved? And then I have to try to figure it out, right? Well, Tony and the underwriting team, within an hour, will give you a list. Is it on Fannie's blacklist or not? Or is it approved? If it's approved, when is it expiring? Those things all matter, okay? We just recently had a condo project on a blacklist where Tony called Fannie and said, hey, you're asking for insurance that doesn't exist in the state of California. They're like, oh, shoot, you're right. Sorry, it's off the list now, okay? So these things matter because it makes a huge difference in buyer pool demand. FHA VA2. We just got a condo project approved in 11 calendar days when my agent got into escrow on a condo project that was not VA approved. The listing agent said, I don't know. The buyer's agent said, I don't know. So I'm like, okay, fair enough. 11 calendar days, we got the entire project approved. We have our underwriting manager working with VA directly. And then on the insurance piece, because I didn't plug MK, it's funny, we're kind of in opposite worlds. So captive agencies, I know they're working hard. There's a lot of wonderful people working for the State Farms, the AAAs, et cetera. But they're also pretty handcuffed these days with everything going on. I know it's getting better, I do. And I know they're rolling out more product, and I have a lot of empathy for them. But MK's in a unique circumstance where she can offer multiple platforms, and she can go to not just the best price, but the appropriate type of coverage, because it's not just about price insurance. You do want to know you're covered correctly. And she saved our bacon a lot of times, so I just want to acknowledge MK for that and say thank you. Guys, you did a great job today. Are we ready to ask some questions of our speakers? Oh, okay. All right, guys, Logan, Steven, we got one mic you're going to share. And then as long as the Q&A lasts, as long as we will be here, team, I really appreciate the opportunity to educate and do our thing in front of you. All right, here you go, guys.
Do it now. Raise your hand.
Will you guys agree with this? My question would be, who do you usually have more voters this upcoming year, buyers or sellers? You want
It really depends on where rates are. I think when rates get a little bit lower, low sixes, high fives, the seller will have always a little bit of an advantage in that. But rates above 6.5 to 7.5, buyers will have that advantage. Every place is different with their supply, but this is one of those years where it's really a tug of war because rates are much lower than they were at the peak in the last few years, but inventory should grow again. So my whole theme is just this tug of war. But sellers, when rates get down to 6.25, 5.75, those areas we're going to be a little bit more say or advantage. But there's been margins on the supply and demand curve.
Yeah, ditto. That's basically what the forecast talks about. We're above 6.5%. We'll be growing inventory like we did the last couple of years. It's just more homes coming on the market. We will have more homes, period, that come on the market this year compared to last year and going back to 2023. So we'll have more homes coming on the market, but if we're above 6.5%, our pending sales activity will be less. So they'll accumulate, and that's how we'll build a larger inventory. The lower rates go, the harder it's going to be to build on what we did last year. So if we're at 6 or 5.75, if we get into the 5s, yeah, I don't even think we can build the same amount of inventory locally that we did last year. So it depends upon rates.
Easier. I got a question. Oh, yes, first.
So they were say 2026. If you were to say 2026 is going to be better than 2025 for these three reasons, how do you want to say? What was it in there? Does those the what combination both? What would you put the three bullet points at?
Better rates, more houses. What would be the third reason, Logan?
The number one reason is better mortgage spreads. If we did not have better mortgage spreads, rates are over 7% today. So spreads are number one in the history of mortgage spreads. At this point of the cycle, they head lower and they stay lower. Today's a really good example. If we had the same mortgage spreads of last year, rates are 6.5. The same spreads 2 years ago were 7%. So mortgage spreads are number one. Number two, because home price growth has slowed down the last 2 years and wages have outpaced home prices, affordability naturally got better by itself. And because of that, that meant inventory is growing. So it is a buyer and seller's market, a tug of war. That wasn't the case the last few years where because inventory was so low, prices kept on going more than they should have. And naturally, the third is, it is the midterms, and they are going to throw whatever they can out here. That $200 billion mortgage-backed security purchase would not probably have happened if it wasn't the midterms. So those three things are things that were not the case in the last few years, and we've seen that in the second half of 2025. When mortgage rates get down to 6% and just stay there, demand grows. We had 420,000 more sales in America since mid-June. So sticking down to low sixes, better mortgage spreads, more inventory, price growth cooling down, and midterms are three things about 2026 that are different than the last few years.
Logan, can you help us understand why the mortgage spread normalized, or at least almost normalized?
So whenever mortgage rates shoot straight up, mortgage spreads get worse, get to compensate investors. Early payoff risk, investors need a little bit more, better yields. But the history of economic cycles, when the Fed is done hiking rates and they start cutting, over time, mortgage spreads get better. So what they're doing right now, before the government purchased $200 billion of mortgage-backed securities, they were almost back to normal, and that looks like every cycle I've seen post the 1970s. Sometimes when you have a recession very fast, spreads could get up. fast because of compensation for investors that are those homeowners are going to lose their house and they're going to get an early payoff risk. But in general, the spreads getting better now looks very normal to previous cycles.
So a lot has to be with Fed. I have yet to understand a $200 billion mortgage-backed security announcement, because when I hear Trump say something like that, politics aside, it's like, okay, is that just, the same thing as a 50-year mortgage, for example, or is this actually happening? Because I saw rates drop on the analysis, then they went back up. Is this a real thing or just dropping?
They started purchasing mortgage-backed securities midpoint last year. So out of the 200 billion, in a sense, 80 to 90 billion have already been purchased. So Freddie and Fannie used to be big purchases of mortgage-backed securities. So this is kind of already in the works. My theory is that, and I say this because President Trump shares my articles, I talk to the people that work there, they knew there's going to be a lot of drama. We have Greenland, we have Japan, we also have the Federal Reserve Supreme Court hearing, and these things can create volatility in the marketplaces. So today's a good example. Mortgage spreads, if they weren't as good at the start of the year, 6.35, 6.40 rates. So I think that they got a little bit ahead of the news that they thought was coming. But in an election year, again, they won't let things get too out of hand. Just like last year, Godzilla tariffs, all that stuff, when the market dropped 20%, but when the bond market starts to go up on them, they flip the tune. So just always think of midterms, and they got to be a little bit mindful of how the market reacts to some of the things they do.
Hey guys, thank you for everything that you've spoken about today. Quick question. I know we've talked about the Japanese exclusion for many years now, raised it from 250 to 500 and $1 billion. In your estimation, do you think that's going to happen this year, or just yes? And if so, if you could create a RAF, what percentage of extra inventory would we get some of those people that said, I have $1 million Jeffrey now, I'll let sell?
That's a California and New York story. And I call this tombstone economics. The baby boomers just love living in their homes. And not a lot of them move, but if you get that extra 500,000, I mean, my parents live in Laguna Hills, and their house is 1.7 million, no mortgage on it. I'm pretty sure they would sell, but inventory supply is a function of demand. So those homes that are going onto the market, they also get gobbled up in terms of the buyer, and that seller becomes a buyer. That's why inventory doesn't ever escalate. So always think of, you can get more sellers, because I would say 83% of those that do not have a mortgage are ages 55 and up, and a lot of that California and New York. So it really depends on if that seller wants to sell and buy another house. I think they will do something, but they might not make it as simple as 500,000 to 1 million. They might have a clause where, a certain percentage at a certain level can increase that deduction up. But I think they're going to throw everything they can, get announced tomorrow even, about what they're going to try to get done, what can get approved by Congress and get it go. But I wouldn't put too much weight on anything until it gets signed, right? Once something gets signed as a law and can do it, then you've got something to work with, and then you could model stuff out. But for right now, there's a lot of speculation on what can or what can't happen.
Yeah, we've been actually talking about this for years now. It's actually legislation that's sitting there on Capitol Hill. And I used to say the chance of it happening were like it's snowing here, but now it's more like it's closer to 50-50 now that they're talking about it. It might be something they bring up at Davos. We don't even know. It's just, it could come up, but then it's just them saying it is one thing, but then enacting it, that's another whole thing altogether. So it's like what he says, the blue states that it kind of affects, but these are also, it's both sides of the aisle. I don't see how you can argue against it. because those were, they put those capital gains together. It's tagged in $1997. So $500,000 home for a couple back in 1997 is way different than what it is today. So it shouldn't changed over time. It didn't. It's still pegged at that same. So what that's done is it's kept people from moving. Basically, a lot of baby boomers, but it's not just baby boomers. We've heard it from other people because of how much values have come up. They just don't want to move. They just don't want to spend anything on capital gains. So I give it like a 50-50 chance, just something to speculate about, but it's better than it was last year, definitely better than it was a couple of years ago. At least they're talking about more solutions.
Also, we have to realize, what do the states do with this law? Because capital gains is something that states use as their budgets. Certain states might not allow that exclusion to go untaxed. So there's a lot of questions on what can it be, but I just say it simple like this. If the Republicans are putting this on the docket and they know this helps California and New York the most, there's something there going on that's not usually the case in the last 20 years.
Hey guys, my name is Sonia Rodriguez. Thank you guys for all of the information and some great talking points from my own social media that I picked up today. It had to be one data line that market participants are underweighting in today's market. What do you think it is? So that we have something kind of a base in our pockets when we're talking to buyers and sellers.
For me, what's easy, it's the new listings data. The new listings data has accurately told us if the housing market is actually really breaking or is it just a normal cycle. Hardly anybody knows about it. We could break it down for every single city, zip code, or state or county, but the new listings data to me is if we just get a little bit of new listings data growth and it stays normal, it's a very normal supply and demand equilibrium market. When it was breaking in 2007 and 8, that was a red flag that things were different out there. So I'm a little bit biased, but our new listings data has been one of the more accurate data lines that hardly anyone knows about.
Yeah, interesting, because we provide that with our reports, the new homes, the number of new homes coming on the market. We follow that religiously. And but some I'm going to be watching is this year's a breakout in demand, year-over-year demand. Because yes, we did get more purchase applications, and a lot of that had to do with the number of homeowners as well that were listing their homes. They oftentimes meet and get a purchase application going because they're going to sell, they're going to go buy something else. But a lot of the plans changed when their homes didn't move. So that was part of that increase in purchase application data. But what I want to see is the follow through with these low rates, see demand jump from this last 3 years. So I'm watching that extremely carefully. Not too happy about the first couple of weeks, but that had a lot to do with the number of homes coming on the market. But demand, we're starting really low. It'll be interesting to see 6% interest rates, if we could hold here, match up with our winter. When I say winter, I'm talking for the rest of January, February, the beginning of March market, as well as spring. It will be a different material market because right now, a year ago, we were 1% higher in rates. And I showed you the math in Orange County. It is huge. So that's what I'll be watching, pending sales data, my demand curve.
I have all those numbers. I'm one of those weirdos that loves all this stuff. So you guys don't have questions. I'll just keep on. How much will the bed share make a difference to this year, to both Wall Street as well as the market? And who you like as the premier and why? Sorry.
Yeah, I might. We had this conversation before. We've actually heard him talk quite a bit too. So I mean, I'm in the Christopher Waller camp. I'm hoping the Kevins both get nicked, and one of them got nixed. But overall, it's like what he was talking about. They're going to be more dovish, them talking that way. But that doesn't mean that all of a sudden they're going to be changing policy and we're going to see rates. Because I had people that text me when they were drinking on a Friday night, the agents that have my, yeah. And somebody else said I was on pain medication when I did that. It's pretty funny. But they were texting me late at night saying, so if the Federal Reserve, if Jerome Powell is fired, are we going to get low low rates in the fours? The answer is no, it's not going to happen. And that's just one vote, and there are 12 of them that are voting. For policy to go up or down, the Federal Reserve rate, it takes 7 out of 12. If it's tied, 6 out of 12, it does nothing. And they're pretty locked into their dual mandate, other than Steve Moran, who's calling for a half-point rate cut right now. But I think it'll be a change in tone. I can't wait for a change in tone. I'm not a fan of any Fed president going back in time, other than in the 1980s when somebody finally said, we need to fix this thing. But other than that, I have not been a fan of the way they speak. It's just my personal preference, but I like hearing a different tune. But does that mean that it's going to change policy? No. We'll still have a Fed tracker. We'll still see where rates should go, and the 10-year Treasury is going to go where the Fed should go anyways.
I still believe the most important variable is the labor market. Whoever the Fed chairman is, if the labor market starts to improve, job creation is 130, 150,000, unemployment rate is falling, wage growth is picking up, not going down, that'll be more important than who the Fed chairman is. But the Fed chairman, again, is one person. I don't like either of the Kevins. Christopher Waller would be my choice, but he's a Fed governor already, so that's probably not going to happen. But I think the more interesting aspect is if somehow the president has the ability to fire governors, then you can get the numbers. Then it becomes a very different ball game in that. So if that happens, that changes the whole paradigm of how the markets would think about the Federal Reserve, because it wouldn't be an independent entity. So, but for me right now, I'm only going to deal with what I know, and the labor market has been the number one reason for rates to go up or go down. And last year was a good case, and we're starting the year off with the job markets not breaking, but still slow. That to me is more important for mortgage rates in 2026. But whoever the next Fed chairman is going to be much more dovish sounding. It's just 2 to 3 more votes on the governor's side. That would be the real game changer in that.
And do your own research. Do your own research when it comes to why you don't want to fix the Federal Reserve. It's not a political statement. It's from good economics. You can do your research too, and research Burns and Nixon to figure out what happens when a presidential administration is trying to strong arm the Fed. It's not good for inflation, and it's not good for long-term rates over time. So I like my economics. I like it slow and boring, and please don't try to fix things a different way, because when you start monkeying with all the levers, something breaks, and that's not what we want to really see. So I hope that you can't go out and fire half the Federal Reserve. That's darn sure.
Again, maybe I could ask the question and also provide a vessel. I'll throw that one out of the way. JJ came into my world a couple months ago where I asked video timer that wasn't even familiar with what you guys were doing for, quite honestly, but I had a client that shouts me while I was there at the studio, and I handed off about the answer you had to say. Thank you so much. He said you did an amazing pile, and it's a two good transaction. So thank you, JJ. So thank you. My question for you guys, specifically, you shared with us on how many homeowners have a block equity. If I remember correctly, it's about 40%. Out of curiosity, the equity in those homes, you can clearly see that they perform very well by owning their homes and watching accelerate throughout seasons. I'm also curious, because now they've lost some of the tax benefits that we talked about, as well as now their equity strong while they understand how well their asset has performed. Is there any way to understand for me to understand better why they're not parlaying that equity position into secondary, third, fourth, and fifth asset? Because like some of the charts are showing,
primary residence per dairy, like the magnitude folks had 5, 7 portfolios was pretty limited, right? Does that make sense, the question asked?
Yeah, yeah. As far as investment purposes, they need to probably sit down with somebody that can show them that. And a lot of them just have their 401ks or something set aside. For many Americans, it's just it's a forced asset that they get to own, and they get to see it multiply and do really well. Other than that, they don't put their feet in the water. So that's the real thing is education more than anything else, and so they can find out there are things they can do with all that extra equity. But for a lot of them, they're really reluctant. They don't know the ground rules. They knew that they needed to go purchase, and are sitting with mounds and mounds of equity, and they go, well, I did well. And that's about the extent of it. So that's for most Americans, that's the way it is. So we have to actually lead them with breadcrumbs to understanding what they can actually do. Maybe buy second, third homes, that type of thing. That would be a smart thing to do, but who knows? Might limit the investor's ability to do that. Might only be able to own one home. Just kidding.
From my experience, our family's been in banking since the late 1950s, and these people just look at their house as a house. And if there's one thing that the housing bubble did show everyone, when homeowners think they're investors, they sometimes get slaughtered. I mean, absolutely using the leverage in their house and buy 2 or 3 properties. It did not work. That left such a bad taste into so many people, and they're like, this is our home, this is where we live in, I don't have a mortgage, I'm gonna enjoy the rest of my life. That peace of mind outweighs any possibility of, oh, I can make 9% if I did this or anything. So that's why you have the percentage of homeowners, a lot of them are ages 55 and up, so they just look at it as a house, and they have nothing to, just property taxes and insurance and keep up, and to them, they could care less about investment. That's why the percentage is growing and growing and growing. In the equity extraction, you see HELOCs being picked up just a little bit, but nothing big in a big fashion, so it's just home sweet home for them.
My whole list spoke on this already, but a big challenge my generation kind of mid-30s people are finding is the cost of houses are a lot more expensive than they were 6, 7, 8 years ago. So a lot of us missed the 2020 boat as well. So we're all now entering bar to try and buy. Any advice that you would give if they're thinking, hey, we're waiting for things to get less expensive or whatever, maybe, and so you buy city power in that area?
I mean, the history of home prices nationally falling is very rare. Oddly enough, 1946 and 1947 was the hottest home price growth period, and that was a lot of people coming back from war and buying, and they thought, what, do I need to wait? Make a plan on a total payment, and that total payment really is more important than the price, and because of taxes and insurance and everything, you have to just think of it payment first rather than price. And we just do not have a lot of history with home prices coming down a lot. We do have a lot of history of price growth cooling down and wages picking up. That's been more normal post-World War II than deflation. The history of home prices falling and the unemployment rates rising. The 1990s was a recession, but that was very little in 2008. 2008 is obviously not going to happen, but price growth cooling down, wages rising, that total payment goal is what you strive for, because that is a moving variable. And of course, dual household incomes are one of the more powerful ways of fighting higher payments. I'm not saying go get married right away and get yourself a second income, but think payment first, and always be mindful where that's going each and every single year rather than a price or a taxes or insurance.
Yeah, so I pray a lot, like I said, for millennials and Gen Zs, and I'm not kidding you. It's a true, actual prayer because I have millennials. I have a Gen Alpha. So in Zeke, he's going to turn 8 in a couple weeks. But it really, you can already see going from 7% to 6%, $5,000 per month. You're now looking at a $1 million house. You weren't looking at that at 7%. So already we're seeing improvement in affordability, and you can imagine that getting down into the 5s, like I said, baby steps, because we haven't been playing the spring market where it's as affordable as it is right now, so that those millennials and Gen Zs can get in. So that's kind of it. I would get in when you know that financially you can get in. B, I would grab a brother or a sister or somebody you know. I mean, my 3 boys live with each other right now. They're not yet married. They're in their 20s, but I'm sure down the road what they could do is they could actually rent out one of their rooms, and which would offset some of that. There's got to be things they think of in order to be able to do it and pull the trigger here in California. But already rates coming down is a big bonus. And if we get down in the 5s, things would be absolutely nuts. If we get in the 5s towards the fall, and that carries us into the start of next year, that would be an easier transition to the 5s, which is what I'm for millennials and Gen Zs, because like you were talking about COVID, very hard to get in COVID when my generation and boomers, they were going crazy, and they're the ones that have lots of great credit. They've been around for a long time. They can do whatever they want, that type of thing, and refinance into these low rates, but they've already done it. So they're the ones that benefited the most. Even though millennials have been coming in, when they were supposed to come in, it was right during COVID. And that's when they were they had a hard time purchasing. And then once it was better to purchase, now we have rates that are really high. So it offset that, wow, it's so much more favorable for them. So that's why baby steps, we're getting there. We're finally there, and we have more inventory as well. And so buyers are a little bit more reluctant on overpaying for something. I just don't want it to be such a good deal that they jump in, and things just go nuts. So baby steps.
About 18 months ago, I spoke to millennials and Gen Z, and one bit of advice I gave them is make sure not to take on a huge car loan and have an $850 payment, because that will strip out your buying power more than people think. And I remember just 3 weeks ago, one of those millennials came to me and said, we only bought this house because we didn't get too expensive car loans, because we would not have qualified. So if you're talking from a younger standpoint where it's going to take some time, be careful of the installment loans that come on, because they will take away your buying power for the future.
Go ahead. Have you done any research on, say, the population of the baby unfortunately, and the aspires that there will be a fortunatamente that there will be any more for surplus that will leverage these out.
This is my favorite subject of all time. The silver tsunami. The silver tsunami was going to happen in 2008. The first baby boomer hit 62. So from 2015 to 2025 was supposed to be the surge of baby boomers downsizing to millennials who couldn't buy homes, and active inventory was supposed to, they still use this number, 26 to 32 million active inventory homes were supposed to be in the market. It's 2026 and we're at 1.18 million. So death, 2035 and on, when the baby boomers start dying off in bigger numbers, they will give their homes to their children. From 2035 to 2045, that is something to think about. But the silver tsunami, in the sense of massive baby boomers putting their homes into the market and creating a surplus, a massive surplus. We just have to remember, our country, we have a lot of millennials and Gen Z and Gen A. For example, 30% of Japan's population will be dead by the end of the century. They sell more adult diapers than baby diapers. We have so much young people that the supply and demand equilibrium, it was always going to be fine. But 2035 and on, no one's Dorian Gray, nature wins, we all live and we all die. We don't take our homes with us. That period of time is more interesting on the death theory rather than the silver tsunami downsizing theory. They love living in their homes. And what happened over COVID too is how many people really want to live in a senior care center now? So baby boomers are more prone to live in their house forever, but 10 years from now, 10 or 15 years from now, death, what their kids do with the property is going to be very interesting, because we're talking about $60-70 trillion worth of home values that are going to be given to their children. That's a lot of wealth that'll go through it.
Yeah, that's the whole aging in place thing. There's a whole industry that's wrapped around aging in place, which people then stay in their homes. So it's like what he said, it's later on down the road. But it's kind of like that. I believe like most everything that all these doomers and everybody else bring up, if there's any change in the marketplace, it's like this slow moving dial that is absorbed over time. We actually need more homes to be built according to a lot of different people. Instead of building them, a lot of them will be just exchanging hands. But when somebody passes and the heirs get the property, they all don't sell. That's the other thing you have to think of. Some of them will live in the property, and there's a whole good tax reason why. Some of them will turn it into rentals. That's a bit of an issue, but they might have lots of capital in order to do it. And the third one is sell it. So not all of them are going to sell right away, which is why I say we're making a lot of hay about nothing, and they've been making a lot of hay for so much time that, yeah, it's going to change over time, but it's going to be this slow-moving dial where you're going to wonder how we got here. That type of thing. It will add to inventory, but it's like the addition of inventory from 2022 numbers, 2025, you felt the big difference from 2023 actually to 2025. You saw the difference in inventory levels, but it's not going to be so out of bounds where it creates this giant disproportion on that scale of between the number of homeowners that want to sell and demand, because the demand's there. There are Gen Zs, millennials that want to purchase. There are Gen Zs that want to purchase. There will be alphas that want to purchase. This is just the way of life, but we like to make a lot of hay about nothing. And that's one of the things that I think that, yeah, it will change, but you're not going to really notice it. Did anybody see the big change in the being able to take your property taxes that California did multiple times and go up and all that stuff? And everybody's talking about how much more transactions it was gonna cause, and it never materialized to much of anything. It's the same thing with the subdividing properties and all that stuff. It's a lot of these things sound good, but at the end of the day, I think it was Harvard that did a study, or Berkeley, I can't remember. And now I'm getting old, so I can't remember exactly which one. But they had this funnel where they talk about the number of people that qualify to be able to do this, and the actual people that do it. It gets to be less and less and less. That funnel gets narrower and narrower, and the ones that actually execute that, it's really small. So it's the same thing that I think is going to happen. Yes, it will add, but it will be a smaller number than what everybody's anticipating.
Real quick, just want to jump in on that. I've got 4 original and others that passed away the last year on our street. And then 2 of them, the kids lived in. And what's constitution that allows us to keep the tax dates or against the board comment it put now? This Nadia, like the she's the 80s super slayer content, I guess. So I've been like both my wife is about kind of stir anger moving as a primary was this people portion of that tax bit. Wild land sold and cash investor bought it and everything. And another one just has my boys have been taking out trash. He did grab a nail as the pan appeared up to do with that all the leak for skipping it. So to their point, when you're soldiers do not pay, I think this concept it's up. There's in doctors that we sold the either. And that's which trusts. There's inheritance, there's family, that's thing really be sense. Called anything right. They're just pointing that up from my own personal experience. The other thing I was just going to mention about, entry requirement for affordability. We forgot something called the stepping stone property, I think, for some reason. We're at Hennessy Beach, and when I lost $2 a pebble, my wife workers, I am a slider for 1,000, I paid check, 1,300 square feet. That's now a $1.4 million. So it's a lot harder. But what I'm talking to buyers, they want to be like the bougie part of this Mason or 17th Street. On the turnkey situation, and they're like, okay, so you want $12,000 a month. I don't know why we've lost the concept.
you are can to, I don't know, a more affordable city and a start condo that needs work, and your gut veteran parker and you got strikes you on there, gut king, and you got to perfect policy like every years, and over the course of 3 years, right, and I'm to a point where sweat equity has got them up to speed as a little more it feels like or sweat equity, power dollars increase actually because of what they did, the market appreciation. Now, what does that mean they can do eventually? Why do they pull this sentence in the property? I'd like to hear more about that language in our industry around talking to first-time buyers. It doesn't have to be the bungalow. Is the east side person he's adopted? Yeah, so I get. But let's face ourselves. I could question, and if you guys don't keep going, that's like, these had your interview on major news agencies, and not every day it is not to ask personal questions like this, so don't be shy. We're talking about direction of interest rates, right? National labor, y'all agree, was going to be the deciding factor. What is your feeling on where it's actually going to head this year? What I've heard is the unemployment rate goes up over 50 basis points, and it's not that frame, right? He's still putting the 2 case calculator too. And I understand we've been a lot of things aren't really showing anything, but are we thinking that it's going to be this slow of a short train wreck, or are we going to have a recovery because of whatever the current administration is doing?
For this year, our base case, because everything has to happen during the winter and spring. Other than that, it's like yours feels like it's over with by the time it gets to the end of July. And now we're talking a totally different thing. But what's happening right now, and our base case is 6 to 6.5%. I mean, that's our base case. And what we really feel is going to happen in our rate, that we should be below 6.25. And a lot of it has to do with labor. That's just how we feel the labor market's going to work, but we don't think it's going to break. What you're talking about is break further if it continues to go up. That's not what we see. And we just, it's not a strong labor market, but it's like, it's okay. I hate it. Or have we actually added jobs? What is it? 0 jobs that we needed to add, Logan? Is that how many it was? But anyway, we see it right there. We do not see it going. I really don't. I don't see it breaking further, because if it did, then we get into the 5s. Is there a possibility that happens? Absolutely. But my crystal ball, which is a little fuzzy, that's what we kind of see is kind of like more of what we've already seen. And it's been really a slow progression anyways of this downward movement in labor anyways. And so that's our base case.
So every year I forecast rates, not targeting mortgage rates, but the 10-year yield and where mortgage spreads are going to go. 5.75 to 6.75, the range. Every year, rates go in a range, but it really revolves around the 10-year yield. But because mortgage spreads are so much lower now, it makes it really hard to get rates, 6.75 or something in that nature. You have to have an economy that's really starting to kick up in gear and inflation picking up. So low 6s, mid 6s maybe, but to get under 5.75% is very difficult with Fed policy being at neutral. You would need mortgage spreads to get back to the low end normal side, or you need the Fed to change their tune, which possibly could happen, or you need the labor market to get worse. The labor market gets worse, you could get in the mid 5s mortgage rates. But if the labor market just stabilizes, rates are just going to be around here. There's going to be more stability with rates this year than the last few years, just because the spreads are normal. Today's a really great example. Today the markets are going crazy and everything, and even though mortgage rates are up 14 basis points, we're still at 6.21%, where in the last 2 years you're 6.5, 6.75, something to that nature. So low 6s for majority of the year, but if the labor market breaks, that's your best case for mortgage rates to go below 5.75.
This is a little bit out of Kirby, but you guys have a good overview. AI, how do you see that reshaping in 2007, I think in 2026, about the ton inventory, and then for realtors as well? That's how you see implementation.
I mean, to me, AI, a lot of people are hanging on the productivity miracle of AI to help the U.S. economy, but like all new technologies, they can create some jobs. They don't really create mass unemployment either. I know a lot of people are concerned that AI is going to take all the jobs away. I've kept newspaper clips going back to 1870, and every decade there's some technology that's supposed to create, and we still have 7.5 million job openings, pretty much just because death, people dying and aging, makes it very hard to have the unemployment rate go up in a big way. Japan's a really good example. Their unemployment rate has been low for a very long time. They simply just do not have enough people there because they're dying off at an accelerated rate. AI can produce a lot of productivity in certain sectors, but to me, it's more of a tool at this stage, and the valuations are very rich, so it's going to have to do something more to get more of a kick to the economy than what it is doing right now. We're spending a lot of money. Data centers around construction jobs are being implemented because of that, but the percentage of GDP going to AI investment is slowing down now. So we've kind of already gone through the first phase, and to me, you got to show me that this is going to be making the U.S. economy more productive than what people think.
That's interesting, because the internet was supposed to replace what everybody did in this room. We weren't supposed to be selling real estate, because we were supposed to go the way of the travel agencies. Even Costco tried to get in and said that they were going to disrupt real estate. They had a kiosk type of thing. That never happened. It never materialized. So AI, it's making a lot of hay about. It's not nothing, but it's extrapolating out what it is capable of doing. I think that everybody's taken too big of a leap with it. And that's why there's so much around it. We remember the internet bubble, and that popped because of, in 2001, because of overinvestment, all these companies that weren't making any money. It's true today. It's the same thing. A lot of money is being pumped into a lot of different companies where they're not making a lot of money. A lot of these companies won't even be around. And so yeah, it does improve a little bit of productivity. Will it replace jobs? Not necessarily. Will it replace something? Yes, something will be replaced, and everybody will make big giant headlines, just like those doomers and gloomers go to Florida and Texas and talk about how the end of the real estate is here. Look at how values are coming down over here, like as if it's going to happen across the United States. It's just what everybody zooms in on is what happens. I've heard it over and over again, all the tech jobs that are lost in Silicon Valley. I have a housing report that does Silicon Valley. They have a very strong, robust market. So they're not imploded. And San Francisco's had its issues, but it has rebounded too. But you don't hear a lot of people talking about that either. It's because when it's happening, everybody's focusing in on it. And that's kind of the way AI is working right now. Everybody's focusing on it. And if you guys remember one other thing, QR codes, remember when they first came out? Everybody was they were on signs, they were on everybody's cars, they were all over the place, they were gonna totally take off, and they didn't. When did it finally take off? It was like 20 years later, during COVID, because we couldn't touch a menu. They had to clean them all the time, that we had to actually use it. We got used to using them, now we use them, but that was 20 years after everybody said that we were all gonna be using QR codes. Look at what they do in Japan, in the subways. They ordered their food from it, and we're going, we're not doing that. And we didn't do that until we had to do that. So the change will happen, but it'll be a long, slow moving, it's just long, boring economics. That's really what it is. And we get excited about that stuff. It's fun. It's like the spread we were talking about. The spread will get better over time. It takes a long time. People go, no, it's not. Yeah, no, it is. It's gonna get better. No, it's not. Well, yeah, it will. Like it takes a few years for it to happen. But we knew it was happening. Over time, you could actually see it. We're talking about it. People are going, hey, you guys don't know what you're talking about. Yeah, no, we do. Because it's slow and boring and fun to look at and go, we get excited when all of a sudden the spread got really better, like last year. Into this year, at the beginning of the year, we were super excited to see how the spread was doing. I mean, we were excited. Us, Brendan and I were going, can you see the spread did? And that is the dumbest thing that we get excited about that, but that is the way that we work. That's how we are wired, slow and boring.
I am such a nerd about the spread that I was speaking in Utah a few days ago. Mitt Romney and myself were on stage, and they created a peanut butter bar or Jiffy, and they covered with mortgage spreads, rich and creamy. That's how much I love the spreads. And it's been interesting for me to kind of explain it, but for all of you here, the best story last year and this year has been mortgage spreads. It's boring. Economics done right should be boring. It's not designed to be a fun, hot, sexy thing, but You now know why spreads are so important.
Coming out of 2020, felt like we have had paradigm shift on the new buyer and the sales cycle that we have with our clients, right? You have to take some of these planning phase, you have to get that to understand the realities of market, you have to pray for them. Well, affordability is part of their structural plan. How do you see that paradigm shift? So question one, how do you see that paradigm shift moving more towards the beyond where you are today, not what we had in 2020? Then also coming up with the governor's race, coming at their California housing is a hot tip, and that they're starting to lean into that now, talking about getting rid of the large companies or corporation purchasing housing, which you, like said, mentioned for last year, doesn't really affect for our market input is to each dash the purchase. And then two, what is reality create new houses so you actually do have the first time home buyer?
You're never going to see the builders build an excessive amount of housing. It goes against their business model. They've always be able to pull back when their completed units are elevated. So unless the government comes in and pays them to build, they're never going to oversupply any marketplace. Number two, institutional investors are small. I think a real good example, Atlanta had the highest percentage of institutional investors. Out of 100% of their investor class, they were 25%. That was the highest level. Out of the ownership class, 4% of the whole state is investors. California and everywhere else is very minimal. It doesn't even cross my radar. Even if they banned every single one of them, less than 1% of the marketplace doesn't move the needle. And plus, the second, third, fourth tier investors can make them up within hours, replacing their demand because they're so small. In terms of inventory, what we've seen in the last 10 years, when rates get elevated, inventory can grow like it has in the last few years. But to build a first-time home buyer, it's very difficult because of land costs. That's one of the reasons why builders aren't building smaller and smaller homes is land values are so much. And construction productivity, we're still building homes with paper, with nails and hammers. It's not like we have the productivity gains like manufacturing and agriculture did. So Texas built some 500 square foot homes in some parts. That could technically be a affordable first-time home buyer, but with inflation and land cost, you don't really regress back to the old times because it just simply costs too much to build. And a lot of that is land costs around the country. It's just simply too much to build hypothetically affordable housing. So it doesn't get easier in that way, but like I said, the 1980s, very similar. A lot of people said home prices are escalating out of control, rates, nobody's gonna buy homes again. Time. Price growth cools down, wages rise over time. Even back then, which was the worst affordability period post-World War II, when you get wages growing, price growth cooling down, and rates falling a little bit, all of a sudden, we just go back to the traditional housing cycles. I see the same here, but building something for affordability, I always joke around. Has anybody actually seen an affordable house? Like a raise of hand, like what does it look like? Like I don't know what it looks like because I live in California. Everywhere else is affordable to me because a one-bedroom condo in my area is $1 million. But in Kansas, everything's affordable. It's because the wages here, people make a lot of good money here that are home buyers. So it's a difficult problem. It's been a big part of my work that the builders just simply aren't going to solve this because it goes against their interest. The cost to build is just too much. That's inflation, right? That's the downside of a growing economy and growing wages. It's very difficult to bring it back to any previous decade.
Yeah, it's hard to go backwards. The biggest problem with California is we're all, the Silicon Valley and the Bay Area, they were first. They're super expensive. I remember oh my gosh, can't believe how expensive they were. And then we watched us. Now we're at $2 million, $250,000 at the beginning. And you guys sit there, I heard some people say, yeah, that's not really even luxuries. at $2.25 million. So really and you can't put the genie back in the bottle. You need values to plummet, which it's not going to happen. So what we've become is just a really expensive state because of this. My birthday was last week on the 14th. We live down the street from a brewery. Thank you. We lived down the street from a brewery, and we picked up my son we walked over to his elementary school, picked him up when he was done, and we went and did homework out in the patio. And I had a beer, and he had a cream soda, and my wife had some seltzer thing, and it was a beautiful day in paradise. And that's what we pay a premium for it. The premium wasn't that big when I got in the business in 1991. It wasn't that large of a difference, but over time, it is a premium. And it's not going to go away because there's only so much buildable land. We're running out of it. You can go ahead and legislate. You can have a new governor say all the different things they're going to do. Is it going to really impact this? Probably not. It's like, this is just politics, which is why politics, I'm not a big fan of politics. I tell you that. I don't follow it. I follow it because I have to, but I don't follow it religiously and get excited about it. I get excited about the economics and the data and the stats. I told you, we were pumping, doing fist bumps when the spread was getting better at the beginning of this year. That's what we like to follow. That excites me. Not that we're going to go buy Greenland or something like that. That doesn't excite me. That just starts, now you're messing with my 10-year treasury. Now you're messing with my interest rates. Now that's where I get upset. Now I can tell you what the ramifications of doing a lot of different things, pulling levers, can do to rates and things like that. That's more of anything that I do. So as far as there being a fix, no. Over time, I think that over time, as long as we have values that are kind of going flat, but we have wages that are outpacing the increases in home values, that's a good thing. Over time, we will get there. But yeah, I think Jason was talking about it. We got to look at other alternative stepping stones. People don't talk about living in those condos where you're in the middle condo unit, and that was your stepping stone, so you can go purchase something else down the road. I mean, that's what a lot of people did, or condos, townhomes, that type of thing. But or sweat equity that he was talking about. Those are all great things on getting into properties, but that's probably more of the solution. The solution is rates have to come down. It's not going to be anything that you can legislate. That's not going to happen unless they do their little places, and they say, okay, this many have to be this many have to be affordable housing, and this many have to be townhomes or quote, they have to be condominium complexes, but they're really detached 3 stories, and they're selling at $1.2 million. It's ridiculous, but at the end, they can legislate some of that, and they can get rid of a lot of red tape, but it's not going to really move the needle a whole heck of a lot, that's for sure. But it's good that we're having dialogue about it, but it'll move the needle a little bit, but nothing that will be that material.
Okay, we're going to do last question. We're going to do Ralph prizes. Loretta, your team, thank you so much. Speakers, really appreciate all the time. You're a lot of cast. I really, really, really do appreciate that. Do you have time for one more while we get the Ralph prizes done? Sure. Okay. All right, we're bending up. These are winning second round. Really appreciate the patience, and you're going to be rewarded. These aren't Jimmy gets. Don't worry. They're on $5 title picks.